Okay, let's get started. Let me just, before we start, remind people just the rules of engagement here. Each paper has 45 minutes. We have kind of light questions throughout, and we're going to ask the presenters to end a few minutes early so that we can have a few questions at the end as well. First paper is going to be presented by Chris.
Thank you very much, John. And thank you to both of you for putting this paper on the program. This is joint work with Chang-Suk Ma, who's sitting right here. And we are interested in this paper in trying to understand better the responses of durables expenditures after transitory income shocks. There are different ways to motivate this paper, but one way is to try to link it to Hank models, which, as you all know, have become very popular. Ludwig presented a paper on this yesterday. These models have at their core a stronger link between income and spending than previous new Keynesian models, yet they typically do not include durables on the household side. And to us, this was always a little bit puzzling because, in fact, theory that has been known since the 1990s already suggested that durables have a stronger expenditure response than non-durable goods. And so we wanted to explore this further. There are other questions that we want to answer in the process. And of course, there's also already a literature on thinking about this. Nonetheless, we think that there are pieces missing. In particular, oftentimes the data on durable goods is not quite as good as on non-durable goods. Think of the Nielsen data. Sometimes papers are using credit card spending data that is also potentially subject to issues because there's an incentive to cut out the credit card margin. And then for certain historical reasons, some of the estimates are obtained using an estimating equation, which is ultimately motivated by the non-durable goods Euler equation. And to what extent that's restrictive is unclear. On top of that, there's, of course, a general disagreement in this literature on what the MPX or the MPC is. And so we want to revisit this question with a focus on durable goods. Specifically, we want to use both data and an empirical method that is tailored towards durable goods. What do we do more specifically? We study, as some previous studies, the Economic Stimulus Act of 2008. Why revisit this program? It has, from an econometric point of view, very appealing features. In particular, the timing of stimulus payments is, for most of the sample, randomized. And so that's going to be the variation that we're going to seek to exploit. We use data from the Consumer Expenditure Survey, which is very comprehensive and therefore appealing. However, we can innovate a little bit on that margin. It turns out that if you focus on durable goods, this data is available at the monthly frequency. Why is that? Well, durables are lumpy. Most of the time, people buy no durables at all. And in that survey, for most durables, if you report having purchased a durable good, they follow up with a question on when did you buy it. So you get data on the month of purchase. That, in turn, allows us to apply a different estimation method than previous papers have been using. We're going to estimate dynamic treatment effects. That has a couple of advantages. One is we can relax the assumption of any economic model on the shape of the expenditure response that's now unrestricted. And second, we can certainly more transparently state the identification assumptions. The idea here is that if we have randomized receipt timing, that's going to imply parallel trends. And then we can check for anticipation effects with pre-trend tests. Okay. So what do we find? We find an enormous expenditure response. We find that for each dollar of spending of additional income, households spend about 80 cents on that dollar. So this surprised us a lot, and we had to do some work to check that this is correct. In particular, another feature, which at the surface sounds surprising, is that people go out and buy motor vehicles. So they receive a stimulus payment which averages $905 in our sample, and then they go out and buy motor vehicles. So how is that possible? So what appears to happen is that people go out and buy predominantly financed motor vehicles, used motor vehicles, or both. And for instance, we can show that unconditionally, if you go out and buy a financed and used motor vehicle, the cash outlay that's required for this type of purchase is in fact $760, so less than the average stimulus payment. So it's not implausible that people go out and buy motor vehicles. In the process, we discovered something that we think is in part missing from the literature. And in particular, it turns out that the typical thought experiment that we have in mind when thinking about the MPC is not really a good guide to interpreting these estimates. So the typical thought experiment is that income goes up, and then you have $1 more to spend or to save. So a better thought experiment to have in mind to understand these estimates is that the government gives $1 to households. Now some fraction of households goes to a car dealer, says, we want to buy a car, I want to lever up, how much of a loan can you give me? So that loan is going to amount to 40 cents on the dollar in the entire cross-section of households, so not only those that went to the car dealer. So instead of having $1 to spend, households now have $1.4 to spend. And of that $1.4, households purchase durables, 80 cents, and then there's still $0.6 to either buy non-durable goods or to save. So in that sense, that helped us a lot understanding these large expenditure responses. We also have some part of the response being driven by smaller durables as well. Okay. So that's the broad summary. And so I'll start with discussing the policy background, because even though that's probably something that many of you will know, that's very important to setting up a plausible research design. So let me briefly, yeah. I can, if you don't mind, I'll do that rather at the end. So it boils down to one very simple thing, and I can discuss that. Yeah. Yeah.
This question, but I was wondering, given that the households spend so much on durables, in some models, you might think that non-durables might actually go down, because they're trying to.
Yeah.
Anyway, that's a thought.
No, so that's a very fair point. And in fact, with the research design that we use here, we cannot look simultaneously at non-durables because they are not measured at the monthly frequency. Then I have to go back to other methods. But there are other studies, also very careful and good studies, which suggest that in fact the non-durables expenditure response is small, but it's not negative. It's positive, around 0.1. Okay.
Non-durable response
it could go down. Absolutely. Yeah, so that's absolutely true. But it does, on average, this doesn't appear to be happening. These are also studies I should mention that also study the Economic Stimulus Act of 2008. So that sort of rules out, on average, this case that non-durables could fall. But in principle and at the household level, that's certainly a possibility. Yeah. 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 No, thank you. That's a good point. I should mention that sort of these purchases of cars is present in the literature in a couple of other papers. So Josh Hausman, I remember the job market paper. So it's not exactly like that, but I think houses and homes, in fact, after the veterans bonus was cars and homes. That's right. Yeah. So there's certainly antecedents of similar observations in the literature. Okay, let me go back to my policy experiment to tell you what we do. The Economic Stimulus Act of 2008 had several provisions for us. The most important one was the transfers to households. They amounted to between 300 and 600 for most singles, between 600 and 1,200 for most couples, and then there was an additional 300 per qualifying child. Rich enough households would not receive any stimulus payments. There was a threshold when they started being phased out. And also very low income earners would also not receive stimulus payments. So not everyone gets them. Here are some of the key features that we want to have in mind, both for interpreting the estimates and crafting this research design. So the main variation that we want to exploit is this random receipt time, which has been used before. the receipt time dependent on the last 2 digits of tax filer social security numbers, which are essentially randomly assigned. Second, there is likely an anticipated component in the expenditure response. This can matter for 2 reasons. One is that the fact that my income is going up sometime in the near future could trigger, in our models it would, an expenditure response. To the extent that that happens at the same time, we're not going to be able to capture this because it's going to be absorbed in a time fixed effect. Okay, so that means we're not generally going to estimate the entire MPX. So part of it could be missing. Second, not only was the fact that household would receive the stimulus payment known on February 13, but also the entire disbursement schedule was published shortly thereafter. And so what this implies is that households would in principle be able to know when their individual receipt time was. This news was also circulated. It was first put out in some opaque note by the IRS, but then was circulated in the media, and then there were individual letters going to households telling them that at some point they would receive the stimulus payment. So we have to be aware of the possibility that there are anticipation effects in this context. So that's something we're going to have to check. Third, the timing is not randomized for late tax filers. So this creates 2 issues. One is that whether a household is a late tax filer or not is not random variation. And so in fact, that sort of addresses a little bit Eric Swanson's point. So that turns out to be the difference between our study and Valerie's and her co-authors. If I include late tax filers in my sample, I'm going to make an assumption that there's a peritrends assumption that holds between on-time tax filers and late tax filers. And so that is variation that in this literature previously has been excluded. We're going to also exclude it. There's a second issue with late tax filers. Conditional on being late, it turns out that after submitting your income tax return, you can get your stimulus payments, so you start having a little bit control over the time of your stimulus receipt, which is another reason why this is undesirable variation to use. Lastly, the disbursement method, so whether you received the stimulus payment by direct deposit or paper check, was not random. So this depended on how you filed your taxes. And again, this is variation that we don't want to use. So those were the key facts. Now let me put this together and tell you how we use this in setting up our research design. So we are going to work with a sample that only includes stimulus recipients. Non-recipients are not included. This is because there's a concern that if we included it, we would need a much stronger peritrends assumption, which may not hold. Second, we are going to use a statistical method that does not use cross disbursement method variation. We're going to only compare direct deposit recipients earlier to later, not to paper check recipients, and vice versa. So that has been documented by this Broda and Parker paper. That direct deposit recipients look different from paper check recipients, and they could be on different expenditure trends. And we want to not use and make a stronger version of this peritrends assumption that would require those 2 types of recipients to be on the same expenditure trajectories. Third, we're going to drop late recipients for the reasons that I just mentioned. Late recipients, whether you're late or not, is not random, and conditional on being late, you have control over your stimulus time. We're going to adopt the definition of what constitutes late that Parker and co-authors adopted. They allow for a 1-month grace period between the official disbursement schedule and when you report receiving your stimulus payment. And then we'll do a robustness check where we also drop those, and then we'll just strictly stick to the schedule. So in summary, the variation that we're going to use is the random receipt time among on-time recipients within disbursement method. And in the absence of any departures from this rollout of the stimulus program and conditional on being able to identify on-time and late recipients, this variation is purely randomized, which would imply that the peritrends assumption holds. Okay. A separate point from that is whether there were anticipation effects. And so that's something we can absolutely not rule out, and we'll have to check for that in the data. Okay. All right, so here are some distributions. On the left-hand side, you see the distribution of stimulus payments. Most of them were between $400 and $1,200. For some households, they were substantially larger, which is possible if you have lots of children or if you have multiple tax filers within the household. The average stimulus payment is $905. On the right-hand side, you see the distribution of stimulus receipt, color-coded here to distinguish direct deposit recipients and paper check recipients. I will want to discuss this for a minute because this is important given the way the estimator works. So the estimator we're going to use is going to use as a control group the not yet treated observations. Okay, and so if you look, for instance, at the red, for the red, we'll only be able to compute 2 months worth of treatment effects because in the 3rd month, we're going to have no control group left. Okay, and so in that sense, you see that the blue, the paper check recipients, are actually more valuable for us because those stimulus payments are spread over time more than the direct deposit recipients. Okay, so let me move on to the data. We use data from the Consumer Expenditure Survey. Many of you have used it. We use the interview module. It's very detailed and comprehensive. The expenditures are classified at the level of Universal Classification Codes, or UCCs. There's about 500 of those. Examples include food at home, women's footwear, and used truck purchases. To contrast or to illustrate sort of how detailed it is, you'd have another category for food away from home, men's footwear, and new truck purchases. So it's very detailed. We have to define what constitutes durable. That's actually not so easy, but I'll not discuss this here because it turns out that most of the responses in motor vehicles, which are unambiguously durable. We deflate with detailed CPI data. That doesn't make a difference, but is the right thing to do. And then we want to identify in the data which types of UCCs are correctly recorded at the monthly frequency as opposed to smoothed over the reference quarter. So unfortunately, there's no variable in the data set that tells us that, so we have to infer it. And the way we do it is that we impose 2 conditions. So one is we link every UCC to a question on the questionnaire, and then we check whether the questionnaire asked about the month of purchase for the UCC in question. And oftentimes it does. So for instance, if you buy a microwave, then they ask, when did you buy it? And you are asked to report a month. So that's necessary condition number one. The second one is that we check the data. We want to make sure that the data does not look excessively smooth. If you were to buy a microwave every month in the reference quarter, then probably, even though the survey principally elicits this information, the way it's sort of in practice implemented may still be smoothed. And so basically, we are looking there for zeros so that we correctly identify UCCs that are recorded at the monthly frequency. Okay. All right. So now, oops. So now here are some summary statistics. The first column shows you the number of UCCs. There's 515 of these in total, 203 for durable goods. I should mention here that our definition of consumption expenditures aligns with that of the Consumer Expenditure Survey with one difference. We net out vehicle sales. Why do we want to do that? For 2 reasons. One is that in our model, the correct notion of expenditures is net purchases. So if you were to sell an old car and buy a new one, then the difference between the two would be your durable purchase in the model. There's a second reason why we do it, which is that we want to capture value added. For instance, part of the definition of consumer expenditures in the Consumer Expenditures Survey is purchases of used cars. Now, used cars are not entirely, as we all know, value added. By netting out vehicle sales, we capture the dealer margin in the population. And so that makes sure that we obtain value added. So I'll not talk about all of these numbers, but you can see some zeros at the P10. That's to be expected because durables are lumpy and people don't always buy durables. The one number I do want to highlight is the last one here, which is this 95.1. This captures the share of monthly recorded spending of all durables. So the remaining 4.9 are in the Consumer Expenditure Survey, but are smoothed over the reference quarter and will not be able to use that. So our main dependent variable for the study is the monthly recorded spending on durables. All right, so now let's move on to the empirical strategy. We use this estimator by Borosiak, Jaravel, and Spies to estimate dynamic treatment effects. So this is a really nice econometric procedure which helped me understand much better what's going on. There are other procedures out there. We've in fact used all of them. It doesn't make a big difference, but it does allow for heterogeneity in treatment effects. So the two assumptions that I ultimately need are only parallel trends and no anticipation effects. So this estimator has good properties. We can, in the end, use OLS. You get the same thing. The way we implement this estimator is that we include separate time-fixed effects for direct deposit and paper check recipients. So this particular fixed effect ensures that we only do comparisons within direct deposit recipients and within paper check recipients. Let me briefly discuss the identification assumptions. The first is parallel trends. As I already mentioned, if we are correctly able to identify on-time and late recipients, and if there were no departures from the official plan to roll out the stimulus program, then the variation that we use should imply parallel trends. I'll be very clear here. There's no guarantee that this is the case because, in fact, we cannot perfectly identify on-time and late recipients. We can only see the reported receipt month. We don't know, for instance, if we see a June recipient, whether it's an on-time June recipient or a late May recipient. So there's still a little bit of an assumption here, but we're going to run with it. There's nothing we can do about that. Nonetheless, we're much more concerned about the no anticipation effects assumption. So there are, in fact, two reasons why it may not hold. One of which I already mentioned, people knew about the disbursement schedule principally in advance. And the second is that there could be recall error in the way the data is obtained. So for instance, if you receive a stimulus payment in May, then you go out and buy something, and then you report having received it in June, this could give rise to what looks like anticipation effects in the data. And a similar thing applies, in fact, to the reporting of the purchase time of a durable. Okay, so there we are much less certain about it, but we can test for it. Yeah.
Both ways are because we'll go to buy a car, I'm told that well, in a month's time you're going to get a check. And I might say I may as well buy it then.
Yeah. That's entirely correct.
I'm responding to the stimulus check, but I'm really just changing the time from one month to the other.
That's entirely correct.
I think that is for the exercise here. And look at the people who just barely did not qualify to receive the checks and see whether the overall car purchase in that group is different from the overall car purchase in the group that barely received the check. And that would be a good way of seeing this.
So that's a great suggestion. So first of all, I completely agree with you. And for instance, if you think of non-durables, this announcement effect, we would think is always positive. For durable goods, this is not guaranteed. I think that's fair. We haven't done exactly your exercise, but we've looked at aggregates. Is there a collapse in say car purchases around February of 2008? And there's no such collapse. So in that sense, we are relatively confident that there's not a lot of that going on, but we cannot entirely rule it out. We can probably implement your suggestion. Yeah.
Sure, in your identification, something do not clear to me what question you're answering. So I'd like to know, say, among the people who got paper checks, how many more cars did they buy over 6-month period, let's say, relative to what they would have bought otherwise?
Yeah.
If they're following the Fed's rule, maybe they're not anticipating, maybe it's just they're vaguely thinking of buying a car, and the day they get the check, they go out and buy it. You're
Yeah.
going to find a very high margin of propensity.
Yeah.
It could be all these people would have bought a car anyway.
So that's entirely correct. So my goal in this paper is to give you the best estimate, given this experiment, that I can obtain and make the cleanest assumptions and the most transparent assumptions. And it's not going to answer all questions. It's not going to answer this question on what part I'm missing. I don't worry too much about that because there are other papers that have sort of tried to elicit this. For instance, there's this Broder and Parker paper that has tried to measure it. It has asked people, when did you learn about your that you would receive the stimulus payment, then they can check, is there an expenditure response? That's in the context of non-durable, so it's not fully answering this question. There's also a question about the aggregate effectiveness of this entire policy, which is, of course, ultimately what we care about. So there are lots of questions that we're not able to answer. My goal here is I want to obtain the best estimate for the MPX given this experiment.
MPX, it's the effect of getting a paper check in a month.
On spending. Yeah.
And it's been a 6-month level and discovered that just the MPX within a month is 80 cents, but over 6 months it's 0.
Yeah. I can, yeah. No, I completely agree with you. So the sad thing is that I can say nothing about it. Given this research design, I can say nothing about it. So you need to complement this with a model. You need to, in this model, you have to make specific informational assumptions. When did people learn about it? There is, for instance, the Kaplan-Violante model, in which case you could have this effect that Refet was pointing out. They don't really call it a durable, but it's similar to a durable. Whether that's the case in practice, I don't know. I can look at the aggregates. I don't think this is a major issue. And then there's this whole reversal property. So one goal I would have is to go out much further than we can and see if there are fewer car purchases after people bought the durable good. I cannot do that either because, in fact, I'm going to run out of control group. I can't estimate very long expenditure responses. So I'm, in a way, maybe I'm raising more questions than I'm answering. But as I said, my goal here is much more modest. I think it's an interesting question, but if this reversal happens too fast, then I think we kind of fail to stimulate the economy. And so the literature has found different things about this. Some, for instance, the Mian Sufi paper found complete reversal within a year. And so but other papers didn't find that. Johannes.
And that would require strengthening your chance assumption. But it's something that you could test, right? So then you could speak more to questions like what actually happened.
Yeah.
At least somewhat more there, maybe don't just rely.
That's a great suggestion. I agree. So then we can add another version with a stronger peritrends assumption, then we can speak to some of that. Yep. Valerie. Excuse me. We have a technical issue here. Sorry, Valerie, I missed the question.
We aggregated super expenditure survey, like people households that repay sometime, and then they never repay. And we don't see an increase, but we do see a small difference in levels of the statistical. That graph is really hard to see one.
Okay, okay, we're back. So let me
sure what that was.
Okay, let me actually move forward just so that I get through my talk here. So here is the version where I define treatment as the month of stimulus receipt. And so what you see is that 3 and 2 months before stimulus receipt, you don't have any noticeable expenditure response, but 1 month before receipt, you see there is actually a substantial increase of about $200. For some specifications, in particular, when I include lots of pre-trend coefficients, this is not significant. If I only include one, then it is significant. And so, as I mentioned before, there are 2 reasons why this can occur. One is genuine anticipation effects, early responses. The other one is misreporting and timing. We cannot distinguish these 2. But what we will do, and given that both of these possible reasons for this early response are part of the causal response of the causal expenditure response to the stimulus receipt, we will redefine treatment as occurring 1 month before receipt. So then we can capture this early response and we'll subsume it into our MPX. So I also want to mention that this is different from earlier papers who have looked at non-durable goods. There was no such response.
you highlighted before the world imputation is. So one of the goals there is to avoid extra predictions. We have a 7-week window with staggered disbursement of events. After that, you have very little data. So I thought that you could do, at least when we look at instant data, you can only do this for 7 weeks. Here, it'd be interesting to know how you get the estimates 3 months out. Because there has to be.
Yeah, so I already mentioned this is the 1-month grace period, which I adopt from Parker and co-authors. So I allow for some delay in receiving the stimulus payment. I still call these on time. I can do a robustness check where I drop these, and then you're entirely right. Then I cannot estimate that additional month of treatment effects. Okay, so it's an implementation question. It's what I define as late. And so here I chose one definition following the literature. If I follow the strict schedule, I will not be able to estimate that last response. Okay, so now I redefine treatment to occur in the month before receipt. So one sort of side remark here is that this actually makes our identification assumption strictly weaker. Okay, so if in case you're wondering about that. So now treatment occurs 1 month before receipt, and then we have no more noticeable pre-trends. We see in a response of about $250 1 month before receipt that rises to about $300 and then begins to fall. At some point, and this goes a little bit in your in the direction of answering your question, you run out of a control group and the standard errors completely blow up. That's why I cannot answer what David suggested I should look is, further out. I just can't do it with this method. In fact, you can do OLS, impose homogeneity in coefficients. You don't get much more precision either. So here is the sum of the three. The sum of the three monthly estimated treatment effects is 733. That corresponds to an MPX of 0.8. We'll also compute what we call here the CIMA elasticity of spending with respect to this transfer. This is scaled in such a way and interpreted in such a way that this 50.8 means that if a household receives a stimulus payment worth $1,000, the increased spending over average unconditional quarterly expenditures by 50.8%. So it's a very sizable response by that metric too. So now let me do a couple of decompositions. Yeah.
One of your highlights very large DX and durables. Prior work you said earlier, it's because you throw out some people, how you show us this later. I'm just wondering about the size of the standard errors. Can you really reject there's many other papers that have found smaller durable response. Can you reject the point estimates that they have?
No, I can't reject the point estimate. So this is similar to Eric's point. I can discuss this at the end. It boils down, the difference relative to the literature boils down to whether you include late recipients in the sample or not. And I cannot reject equality and coefficients. The standard errors are just too wide for that. Okay. All right. So let me go to the decomposition. Now I want to understand in an accounting sense in which categories expenditures were concentrated. And we see here on the slide, second line, that most of the response was concentrated in motor vehicles. The other categories were positive, but either not significant, or the last row, miscellaneous durables, small but significant. So now let me zoom in further into motor vehicles and parts. So here we break it down into three further categories. The second row shows you vehicle purchases, the net outlay. So this is what you pay for the car after potentially trading in your old car, selling it to the dealer from which you buy the new one. And so that is a very large response, $740. It is partially offset by an increase in sales. That's the last row, about minus 200. It's negative here because this is sales. However, it's very noisy and we cannot make a precise statement here. But what this tells you is motor vehicles are important and potentially used vehicle markets are also important. We have two more decompositions, which we'll not discuss here in detail in the interest of time. One is I want to understand, is it the extensive margin or the intensive margin driving it? In line with much of the literature, it turns out to mostly be the extensive margin, so people buy more cars instead of buying more expensive cars. And second, we find that if you condition on expenditure size, then you also find a significant response for small purchases, which was not statistically detectable in this decomposition by expenditure category. Right? So presumably if you have TVs, Some are expensive, some are inexpensive. And if I look at the entire category, I cannot estimate a precise response. But that's because some of them were large and probably not so easy to purchase with a stimulus payment. So now let me briefly summarize and then answer and then show you some more results to questions that arise from here. So we find these very large responses. Most of these are driven by expenditures on motor vehicles. The extensive margin is important, but there are some responses in smaller items. So what are the follow-up questions? One question is whether vehicles are special. So clearly vehicles are durable goods. But if I would now think about trying to model this, do I need to include in this model other features that vehicles possess which are not only durables? And so that it could be that the purchases of vehicles are very responsive because of these other features that vehicles possess and not because they're durable. So that's number one. And second, I want to ask, how is it possible that people receive stimulus payments of about $905 and then they go out and buy a car, right? So I would have thought this is not possible. But it turns out there's an answer to this. So in what sense are vehicles special? So vehicles are special in what we can identify in the data, particularly 3 dimensions. So one is both unconditionally and conditionally. If you look across UCCs, vehicles are the most important durables. They're also the most lumpy. Second, vehicles have a liquid resale markets, which not other durables don't necessarily have. And lastly, when people buy vehicles, oftentimes this vehicle purchase comes in a bundle with a financing package, right? So you take out a loan and you have to pay an interest rate on that. So this could matter for at least 2 reasons. One is if you take out a loan, then you reduce your cash outlays upon purchase, so that that would potentially facilitate this purchase. Second, if I borrow with collateral, the interest rate is going to be typically lower than uncollateralized borrowing. And so here is a table that speaks to the first of these points. So now I look at all purchases unconditionally of financed motor vehicles between 2007 and 2009. I initially lump used and new vehicles together. The expenditures on one of those vehicles is about 20,000. Then you subtract trade-ins, that's about 2,500. Then you subtract loans, and then you subtract sales, which are other sales not to the dealer from which you purchase the cars. And what you arrive at is that the cash outlays ultimately are just $1,300. So within the ballpark of the stimulus payment. So that speaks to this question: how can this financing potentially facilitate purchases of durable goods? So I can break this both into new and used. If I look at new, the cash outlays required are about 2,000. For used, it's 760. So that's less than the average stimulus payment. So it's not implausible from at least this cash perspective that people buy motor vehicles after receiving these stimulus payments. Now I can do one more decomposition. Does this matter in an accounting sense? And it does. More than half was on financed motor vehicles. I can break this down further into loans and down payments. So here I have to tell you that the data on loans and down payments is not as good. So there's some imputation going on here, and we think actually it's conservative. But if you believe that, then we can show that, in fact, loans go up substantially and account for a very large chunk, 0.4 of the stimulus payment. So this corresponds to an MPLU, a marginal propensity to lever up, of 0.4. So this is where I'm coming from when I said that after the government gives you $1, you lever up and you have $1.4 to spend. And so you have to think about a more generalized budget constraint here. So I have very little time left. Can I postpone this to the end? So now I want to do one more split, which is for new and used motor vehicles. Used account for about 2/3 of the expenditure response. If I further go and break this into finance and not finance, I see that in 3 of these categories of the 4, I see large responses. The only one where I don't see large responses is for new vehicles, which are not financed. So those are precisely the ones where I need large cash outlays to purchase them. And then the financing is similar across these categories. So now I'm almost done. I do want to briefly address Eric's question, or maybe we collect first Valerie and yeah, go ahead.
So really nice paper. I mean, all of us dealing with the CEX and this timing treatment are always up against challenges, and it's very cool how you did the monthly kind of stuff. But as you know from the email that we sent when you nicely sent us the preliminary version, one of the reasons that Johannes, Jake, and I argue our QJE paper is called Micro MPCs and Macro Counterfactuals, and then we follow up in the Economic Journal paper, is that we get big standard errors from the CEX that, you know, there's no getting around it. And yours are even bigger because you're so strict with your sample. And so that's why we have to look at macro counterfactuals. So we already, you know, inspired by Matthew Shapiro and his co-authors' work, we show that motor vehicle sales in the aggregate just cannot be explained. Relative prices go up only 1%. And you just could not, even just for your new vehicles, you would just get crazy counterfactuals. Now, you find a lot with loans. So I went to the Consumer Finance Bureau and downloaded new loan originations for new and used cars. The blue line is the actual, it overlays the orange line before the window. And then I took your estimates and did the Shapiro et al. Kind of thing. And I get big V-shaped counterfactuals suggesting that if you did not have this rebate, and this is with no amplification effects for macro, you would have gotten this dramatic decline in the summer of 2008 of loan originations, and then they would have partially recovered when Lehman Brothers fails. So it has that same V shape that we found in our work. So you just don't see the loans doing what the micro is saying. So,
Yeah.
so this is
No,
a case
thank you
where the
for bringing
micro
this up.
just can't tell us enough.
So
Because
thank you for bringing this up, Valerie. This is actually, it's also speaking a little bit to what Eric was suggesting. So I think there are two inputs into these counterfactuals. One is the estimates, and the other is the model. Okay, and so jointly they produce implausible counterfactual. I completely agree with you on that front. Yeah. So what my goal here is to give you the best estimates for the MPX that I can obtain. And so Eric asked, what is the difference relative to Valerie's, Johannes's, and Jacob Orchard's paper? And so you can track it down to one simple difference. So it's almost exclusively driven by the inclusion of late recipients in the sample. And so, you know, so that's part of the input into this counterfactual. Now I have to ask myself which estimates are more plausible. And so I'm going to come down on my side, okay? And the reason is that there's a very simple reason for this difference. So here in the first column, this is, by the way, their data, their application code. The first column shows the expenditure response that is their baseline based on the sample that is the recipient sample only. And so the expenditure response is 320. If I do one difference, which is to drop late recipients from the sample, for which there are very strong ex ante reasons to do it, you arrive in column 2. So now the expenditure response is 830. So the third column, ignore for a minute. They have a second specification, which is in the appendix, and that the baseline in the appendix is in column 1. The expenditure response is 350. Now I do the same exercise. I drop late recipients. It goes up to over 1,000. And lastly, I do it in our environment. In our environment, we excluded late recipients from the sample to begin with, so we got large responses. In the second column, I dropped them, and so I get much smaller responses. Not all the way down, because there's a second difference, which is the fixed effects, whether they vary by disbursement method or not. But the point is, it's unambiguously clear where it's coming from. It comes from the inclusion of late recipients. And so now, why is that the case? So you can track it down. It comes from a difference in a violated parallel trends assumption effectively. I'll show you this visually here. So this is the time fixed effects for direct deposit recipients, which are on time. They're going down because we're heading into recession and people buy fewer durables. This is what you would expect. If you look at this for late recipients, so then it starts looking like this. So they're on a very different expenditure trend. And in fact, you can, in the data, detect this expenditure trend. It shows up as a significant negative pre-trend. And so basically what I'm trying to say is they're both good ex ante reasons and good ex post reasons, namely a violation of the Perry-Trentz assumption to include late recipients in the sample. And so this is sort of as far as I want to go. So I think our estimates require weaker assumptions, are more plausible. So that leaves us with a second possibility that the model ultimately that you use to construct these counterfactuals are not correct. And so I think the only way to reconcile these large MPXs with plausible counterfactuals is that there has to be a lot of crowding out in the aggregate. So some people buy more cars and then others buy fewer cars, and that amounts to ultimately a small aggregate effect. So that's the way you'd reconcile it. I think this paper actually has a little bit to say on what important components of such a model would be. The used car market is probably an important component. There are others potentially as well. Gabe.
Last question.
It seems like as you're interrogating this literature, thinking about the confidence intervals if they're useful. I mean, the difference here is like 6% of the sample, and then it's very different estimates, and that's because it's only a few people who have to buy it. Like, if they could claim 6 more people buy a car, and they all spend $10,000 on that car, that
Yeah. No, but this is, yeah. So I agree in part, but it's really driven by this inclusion of late recipients because they shape the control group of everyone going forward. So they're super influential observations. So in that sense, I agree with you. But if we can agree that we shouldn't include late recipients, there's actually not that much of variability in the estimates.
It's not across the confidence intervals around the point estimate.
So they are.
The way to reconcile macro thing would be to say, maybe in this particular sample you get 0.8, but maybe the truth in the population is 0.5, and you know, already your confidence intervals are big. And I just wonder whether there's some lumpiness in this data that it's just part of the.
I completely agree with that. I completely agree with that. So there's confidence intervals around these aggregate counterfactuals as well, and we should take this into account. Nonetheless, I mean, we typically work with point estimates because they're the best estimates that we can obtain. Okay, let me wrap up. So we revisit this question on how large durables expenditures respond to these income shocks. They respond a lot. They also lever up. So we think there's some lessons for models. We think that, for instance, in heterogeneous new Keynesian models, we should think much more about durables than we have done before. So thank you very much.
Okay, we're a little bit over time, so we're going to move straight to the next paper, and Xavier is presenting.
Great. Thank you. So hi, everyone. Very happy to be here. Thanks a lot to the organizer for including this paper on the program. This is a paper about temporary VAT cuts in Germany. This is joint work with Gunther and Muzamil, who are sitting over there, and the two Sebastians who might be online. So this paper is motivated by the use of temporary VAT cuts to stimulate the economy in a period when we are at the zero lower bound, like, for example, during the COVID crisis. And this type of policy, where you tell consumers you're going to reduce VAT for, say, 6 months, and then you're going to increase it again, that might be helpful in stimulating aggregate demand if, of course, 2 conditions are met. One, you want the suppliers to pass through the lower VAT to consumers in the form of lower prices. And 2, you want the consumers to be attentive to this, optimize intertemporally, and so they need to have a high enough elasticity of intertemporal substitution. And so there's a sizable literature by now that has characterized pass-through of VAT changes in a variety of contexts, and usually finds sizable pass-through. But still, I think we can say there is a debate about the effectiveness of temporary VAT cuts, because there's a debate on the quantity response to these VAT changes. So a couple of papers that looked at different contexts have found different responses. And then stepping back from VAT changes, there's this broader, long-standing debate in macro and other fields about the value of the elasticity of intertemporal substitution. So let me tell you what we do, preview the results, and then go back to some of these papers to position what we have done and found in that broad literature. So we're going to look at Germany during the COVID crisis, because Germany reduced VAT from July to December 2020. And so we're going to use very detailed microdata, so scanner data of a, kind of a standard type, the fast-moving consumer good, FMCG data that covers non-durable things you find in supermarkets. Many of you have worked with that. And we also have a new data set on durables, slow-moving consumer goods, SMCG, reference here. And that's where a lot of the action could happen, because there are reasons to think that substitution is going to be higher for these durable goods. And so our design is going to be very simple. We're going to look at both prices and quantities in Germany and compare them to what happens in other European countries. And this, of course, will raise some questions. So the main concern might be maybe there's some shock that happens in Germany exactly at the same time as the VAT cut and the VAT increase, and maybe that confounds the results. So we're going to think about that later by exploiting specifically the timing of the policy change and comparing durable and non-durable goods. But that's going to be broadly the design, a diff and diff. And then through the lens of a simple model, in fact, building on Valerie and Johannes's recent work to model durables, we're going to see what our estimates imply for the elasticity of intertemporal substitution. So what do we find? Well, we find high pass-through rates, varying depending on the types of goods. So 65% for durables, 91% for non-durables. But on the other hand, we have no evidence of significant quantity effects. And so it's interesting. I have this problem that this keeps going on its own. So sorry for the slides moving. So no significant evidence of quantity effects through the simple model, accounting for standard errors in our estimates. We can rule out an upper bound of 0.1 in the AIS in the presence of strong adjustment friction. So, of course, this is a bit model dependent. Depending on the types of frictions you put in the model, the AIS will respond differently. But essentially, the reason why we end up with very small AIS is very simple. There's this VAT change, and it's actually quite high relative to the per period user cost for the durables that we study. So the fact that we see no response or a very small response at the upper bound of our confidence interval for these durable goods, while you have strong price incentives to adjust, that implies a small EIS. So that's the plan for the rest of the talk today. So how does this compare to what others have found? So regarding the price effects, there is a big literature that has looked at temporary VAT change, sometimes permanent VAT change, and has found varying degrees of pass-through. And we're broadly in the ballpark of these papers towards the low end for the durable, the high end for the non-durables. And here the advantage that we can compare that with detailed microdata, try very different price indices and check the robustness of these findings. But the main contribution is to the quantity response and the IS, where there is a broader debate. So, for example, Kashin and Unayama, looking at the context of Japan, found very small EIS of 0.2, but cannot reject 0. And in contrast, in more recent work, in fact, looking at Germany, the same policy change as us, the paper by Rudi Bachmann and co-authors, including Olga in the back of the room, found much larger effects with a different design that was asking about who is informed, not informed. And so, to date, we're not sure how to reconcile our estimates. One possibility is we're looking at Germany as a whole. In your paper, you're comparing different groups. So a bit like the previous paper, there's this question of how you aggregate different groups versus country level effects. But so I'll show you what we have, and then we can perhaps go back to that comparison. The point is that here we can look simultaneously at price and quantity responses for both durable, non-durable, and we have this high frequency design that we think is useful then to actually get tight bounds on the AIS through the lens of a simple model. So I'll first tell you about the data, then the empirics, and then we'll conclude with the model implied bound for the EIS. So the data is provided by a nonprofit called IMARC, and this is fairly easily accessible if any of you are interested in the data. And the data originally comes from Nielsen IQ that's recently bought a German company, GfK, that put the data together. So this is transactions data based on scanner data for both durables, non-durable goods for Germany, but also the Netherlands, Italy, Austria. In all 4 countries, these data sets are representative of what you see in national accounts data. It covers about half of household expenditures on goods, a quarter of total household expenditures. What you do not have is shelter, which for VAT is fine. It's not going to be covered by the policy. But we do not see other important things. So we do not see car purchases. We do not see services. So we're not going to make statements about these categories. To give you a bit more flesh about the data, let me give you some examples of what is in the data. So for durables, or the slow-moving consumer goods, as they're called, this comes from a scanner at the point of sale. So we have many stores including in the data set, and this comes from the checkout counters. This is going to cover consumer electronics, furniture, some very expensive domestic appliances like fridges or washer, and some smaller, less expensive one like a microwave. This is going to cover both online, offline purchases, and so we have then millions of transactions, in fact, hundreds of millions of transactions in the 4 countries that we study. And then we also have the more standard data sets, non-durable goods, which many of you have worked with in the US, with the Nielsen data. This is similar, so it's data sets that's obtained by households scanning what they purchase at the supermarket. So it's going to cover food product, beverages, personal care, and these types of item. Again, purchased online, purchased offline, and we have about 30,000 households in Germany and a bit fewer in the other countries. One advantage that for this, we can then study heterogeneity by types of consumers, age, income, and so I'll show you this a bit later. So with this in mind, let me describe the research design, and that will have a series of steps. But first, to be clear about the treatment. So Germany announced on June 3rd, 2020, a big stimulus program, which had a variety of measures, including the temporary VAT cuts and some other components. And we're going to exploit the specific timing of the VAT cut, which does not coincide with the introduction of the other components of the big stimulus program. So the VAT cut, it was in fact of 2 types. There's a standard rate that fell from 19% to 16%, but also a reduced rate for necessities products, for example, some food products that initially was at 7%, then came down to 5%. So they announced this in June 2020. They said we will cut the rate on July 1st, 2020, and indeed they did that. And then they re-raised the rate as planned on January 1st, 2021. Yes. Yes.
What did they say about the moment in June 3rd, 2020? What did they say about the reversal? How credible did it seem? They say, oh.
Yeah. So my understanding, under the control of my German co-authors, is that actually there was some debate about whether they would indeed lower the rates on July 1st. So for the first 2 weeks of June, there was some debate, and it was. Some people said, should we really go ahead? Will the government really go ahead with that? But there was little debate about the fact that it would be temporary and it would go back to normal on January 1st, 2021. So with that in mind, you could take as a grain of salt the estimates I'll show you for June, because you might say maybe people didn't fully believe that, and you might put more weight on the estimates, say in December compared to January. So this research design, and with these so timing of July 1st, January 1st, how does the design work? Well, we're going to run different types of differences. Well, the treatment group is Germany, and then we have the rate cut, the rate increases are 2 treatments, and we're going to use as control groups the Netherlands, Italy, and Austria. So as I briefly mentioned earlier, the assumption is that we can basically have as a counterfactual Germany these 3 other countries, and so the main concern would be that there might be time-varying Germany-specific shocks that happen maybe specifically in July, specifically in January. So we're going to think about this in several ways. So first, we're going to see whether indeed most of the effects is exactly around the timing of the policy change. 2, we're going for prices, and we're able to show you, I think, a very compelling approach that rules out potential time-varying shocks. You'll see very striking effects even within Germany. And for quantities, we can leverage heterogeneity across categories. So by nature of the program, where for more durable goods, you should expect a bigger response than for non-durable goods, you can compare these two categories, and that could still allow for Germany-specific shocks happening exactly in July and January. So overall, we're not too concerned about that case. If you look at the timeline of COVID spreads, containment measure, this is very similar between Germany and the Netherlands. So the big macro shocks are quite similar between these two countries, and we add also other countries as robustness checks, but you can just consider the Netherlands and you get similar results. So that's for the backdrop. And now more specifically, we're going to proceed in 3 steps. One, I'm going to show you this, what I call the graphical approach that closes clear evidence on the modal price change caused by the VAT change. I think this is going to be very useful to rule out time-varying Germany-specific shock because it happens in a very vivid way, exactly when we would expect it to happen. But that's not going to be something we can do for quantities, and it's not going to cover all the types of price changes. So step 2 and 3 will take a more standard approach with a statistical diff and diff design for price pass-through and then for quantity responses. So let's go ahead with step 1, and this graphical evidence. So first, as a kind of benchmark, perfect pass-through in this context means a 2.5% fall in the price, and because you go from a 19% to a 16% VAT rate. That's the benchmark we're going to have as perfect pass-through. Now, you might say, well, your design might be underpowered because we see at the product level a lot of price changes from 1 week to the next or 1 month to the next. And so maybe this is quite hard to really see in a simple way in the data. But in fact, you also know that the price change distribution with menu costs tends to be very concentrated around 0 in most periods. This is true at the week level, but also at the monthly level. And this is true in all periods and countries we've looked at, except Germany, exactly at the time of the policy changes. So I can show you this here. Let's start with the Netherlands. So this is showing the distribution of price changes for certain barcodes here coming from the durables. So here a product is a barcode sold in a certain store, and we track the price, the average price from 1 month to the next. And so this is the density of the price changes, and you see a lot of mass exactly at 0. It just means that most product from 1 month to the next stay exactly at 0. That's true in all months. You can also do this at the weekly level. Same story. Same story in all countries, all period, except Germany. So here you see that there are specifically 2 months in June or in July and then in January 2021, where the mode exactly shifts to minus 2.5% and plus 2.5%. So they indeed pass through the prices, the VAT into prices exactly, at least for the modal price change. There's very clear evidence of 100% pass-through. This is also something we see quite clearly for non-durable. So this is the distribution for the Netherlands. Again, a very similar distribution in all months. But for Germany, you see the distributions that shift exactly in the 2 months where the VAT cut is introduced in July, and then when it's discontinued in January. So this is interesting, suggests high pass-through, but it's really clear just for the modal change. So we're going to have to do something else to have a look at all products together. And also, it's not feasible for quantities because there's no stable part of the distribution of quantities, like we have this modal null price change that occupies a large part of the distribution. So then what we're going to do is build price indices and quantity indices. I'm going to show you results with Turnquist price indices, and then there will be robustness with other price indices. Turnquist is one of the standard price indices that offers a good second-order approximation to any standard well-behaved utility function. And so it takes a weighted average of a geometric weighted average of price changes from one period to the next. So here a period is going to be a month. You can also do this at the week level. Geometric average where the weights are the expenditure shares in the base period and the end period. Yes.
Given that your comparison is going to be like Germany versus the Netherlands, you might have thought, or if you were doing this 20 years ago, we wouldn't have had these scanner data, and you would have just gone to the national accounts and retail sales and the CPI and used that. So can you just say succinctly what's the benefit of having all of these detailed
Yeah.
item data?
Yeah. So we have also done that, and so it's in the robustness layer, and it gives very similar picture. The advantage here is that we have full control over what we do, and so, for example, quantities for statistical agencies just follow items that they find on the shelf, but you actually don't keep track at the product level of the changes in the types of goods that are purchased. So this is a much better measure at the micro level of what is actually happening to consumers. For example, if consumers buy lower quality items, that we can keep track of. We couldn't do this with standard CPI data. And the other advantage that we're going to be able to study heterogeneity by consumer income, consumer age, this type of thing. But for the most part, we can indeed, the headline numbers, we can have them from the standard CPI and national accounts data. So Turnquist for price, you can do the same thing for quantities. And then once we have that, we can run a standard diff-in-diff style analysis. So we're going to have our outcomes, it's going to be price changes, and we're going to then have here with the beta M coefficients, this is going to be the coefficients of interest. So you see here a dummy for Germany interacted with a dummy for time equals a particular month. So we're going to look at a particular time path of the prices specifically for Germany, taking out month fixed effects with the other countries in that are used as controls, so the Netherlands, Italy, Austria. So we have these month dummies, a Germany dummy, and then we, in fact, as our outcome, we're going to take out price changes from one month to the next, different stouts with the price changes from a year earlier to take out seasonality patterns. So it turns out that for some goods like gardening equipment, you have strong seasonality, like people buy this in the summer. And so this is helpful to do to reduce noise, but not really for identification. We're also going to estimate the analysis with a weighted least square approach. So we downweigh categories that have usually more noise to try to reduce standard errors. Again, that doesn't change things very much, but that helps us a bit with noise. So with this design, we go ahead and we obtain this type of graph. So this is for non-durable. So these are the coefficients for Germany. So this shows that between January 2020 and June 2020, Germany was behaving in a very similar way compared to the countries in the control group. And then exactly at the time of the VAT cut, indeed prices fell here for non-durables. The line below, the purple line, the dashed line, shows the perfect pass-through line. So you can see that here we get very close to that perfect pass-through line. And then exactly between December and January, we go back up exactly to where we started. For non-durables, the story is slightly different, where you also see a drop in July 2020, but it's not all the way to perfect pass-through. And then you see an increase, but it looks like perhaps a slightly asymmetric pass-through, where it looks like we don't go back fully to the initial price path. So in terms of numbers, if you want to remember some numbers, here they are. The pass-through for durables is 65%. For non-durables, it's 91%. If you use expenditure weights across categories, you obtain an overall pass-through rate of 76%. So far, pretty high pass-through. This is what the policymaker was hoping would happen, and indeed, it seems to be working quite well. So now, what did the consumers do? Is there evidence of a quantity response? So this is what we see here first for non-durables. And so you can see that we do not see very much. Perhaps in December, the point estimate is slightly higher, but we still cannot reject zero. You might think, well, durables are where most of the effect might be expected. For durables, we also don't see very much. And so later, the point of the model will be to interpret this, but just to preview this slightly, if you take like standard EIS of say 0.5 in a standard type of model, here for durables, you would end up having a jump going around plus 40%. So here, the upper bound of the confidence interval is around 10%. So in that sense, it's a small response. Yes.
But we found out that durables were strongly underperformed. And later they have probably had some handy to be using the survey-based analysis. And they have found, of course, that the response increased interoperability and restored very large response for large durables instead for small response. And for some response for semi-durables, which is this kind of data and so forth.
Yeah, great. So yeah, it's a good conversation to have. So my understanding is that, so in your paper, as you said, there's a lot of that is what's with survey, but you also have actual scanner data. And in fact, you have the same as what we have here, which here we call non-durables, because this is when households are instructed to scan what they find in supermarkets. In principle, they can also scan TVs when they buy them, but in practice, they're told this is for food. So you're right that broadly we think that the Nielsen data, this type of data, undercovers durables. So that's why our actual durable measure in scanner data is this other data set, which is new to the literature, that comes from a completely different source, these slow-moving consumer goods. And then, I think there's a separate conversation to have about, the role of this, the informed versus uninformed consumer. That's your identification. Ours here is more like comparing different countries. So I think both have advantages, disadvantages. Yeah.
By taking out Austria, Netherlands, we can learn that they to some extent shot across.
Yes. Mm-hmm. So we've done, we leave one out of each country one by one. We could also just do Italy if that's true. We could also look specifically at try to see at cross-border shopping. We haven't looked at that yet, but in the data, you in principle can do that.
You think that COVID is a time of high uncertainty? So whether you think that can rationalize your response, because very surprising to not see a durable response.
Yeah. So Olga's paper is also during COVID, right? So that's so I think it's already interesting to try to figure out what happened in COVID. But then I agree, we always want to think about whether COVID is very special. So what we have done is see to what extent these results differ depending on the severity of COVID in different parts of Germany. And we have not found substantial heterogeneity. So that's, I think, the extent of what we can do here. But you're right that there's always here, keep in mind that this is a very special period.
But you should clarify that you undersold what the 0.5 IES counterfactual, how high that would have to go? Because isn't there some macro multiplier, like they're doing this in order to try and stimulate spending and then trying to stimulate employment from that spending? And if they get a zero spending response, there's a nice theorem that 0 times anything is 0. But if you're putting in a counterfactual of 0.5, then that stimulates some employment and that should generate even more spending. So I would think the macro response, the macro IES should be larger than the micro IES. And so you said 0.4, but I think maybe you can even push that counterfactual number higher.
Right, because this would have the missing intercept in there. Yeah. Okay, we'll think about that.
It's a multiplier.
Yeah.
It's not an intercept.
Yeah.
It's a, yeah.
Effective make of one. Yeah. So we've looked at heterogeneity by price level. So you compare things like, so you're asking about durables or non-durables or none? So we did non-durables. We haven't found much heterogeneity by initial price level. So yes. Yes, so that was similar. Yeah. No. Great. So yes. Mm-hmm. Mm-hmm. Yeah, I mean, there was a light lockdown for restaurants in November, and then from December there was like the second lockdown, and the timeline of these lockdowns is very similar in the Netherlands. They also don't affect offline purchases, so we see similar similar effects when we just focus on the online purchases. So that's the extent to which we can speak to these questions, I think. Does that help? Right, but so that we see, but I mean, if you look at the control group countries and Germany, they tend to, at different points of the year, substitute toward online. Yep. So that's kind of like, that's what we have here for the non-durable. Durable. So if you want to remember numbers in terms of semi-elasticities, for quantities, they're listed here, but I think it's going to be better to interpret these numbers through the very simple model to see what they imply for EIS. Before we get there, a list of robustness and heterogeneity cuts. So first, we've looked at different subsamples. So I said in response to your question that within non-durable, we haven't found heterogeneity. Within durables, we found much higher pass-through, in fact, close to perfect pass-through for the product categories that are usually cheaper. So things like ink cartridges, paint, buying a hook, this type of household products, and much lower pass-through, below 50% for big ticket items like a fridge. But still, quantity responses were similarly flat across these types of categories. Then there's a long list here of things where there is no meaningful heterogeneity. So no meaningful heterogeneity by durability. So it means similar for prices, similar for quantities. Something I previewed earlier, if you look at places where COVID was stronger, within Germany, same patterns. Income, age, size of households, that doesn't relate to heterogeneous pass-through or heterogeneous quantity responses. Retailer characteristics also don't seem to matter. So supermarket, hypermarket, discounters, we look just at online, just at offline. We also looked at quantile regressions. We might think maybe it's some parts of the distribution that drives these effects, but no, it looks like kind of like the full distribution is moving. Then if you just look at barcodes that remain available for the whole period, you also get similar results. And then finally, you can leave out some control countries, also the same thing. Now, you could also consider alternative specifications, so add more controls. So here again, something related to COVID, you could interact all of these controls with total COVID deaths or national containment policies, leaves the estimates similar. We've also used different price indices and found different things. And then finally, as previewed in response to Gabe's comments, if you use alternative data sources like the CPI or national accounts data for quantities, you get similar things, where you have a similar recovery cycle in Germany and the control countries, and you have perfect pass-through or close to perfect pass-through in the official CPI data. Yes. Yes.
Retailers you see with online purchases, just retailers that also have physical products, or what about sort of Amazon?
So for the non-durable, we see everything they buy in this, whether they buy it offline or online, then they scan when the item arrives and they say if it's online or not. For the point of sale data, I look at my co-authors who might remember how this is recorded for the point of sale.
Online, offline, but they are not done. So basically the data are supposed to cover the full market.
Good. So now we can turn to the simple model. Yes, sir. Yeah.
An experiment, but then was not point estimates, but the standard errors, because it's easier to think about how to do standard errors and that. You don't have a lot of data.
Mm-hmm.
Figure out.
So yeah, I think that we have larger standard errors, but with the standard data we have way more categories. We can control for various strands, but I don't remember on the top of my head. But that's another reason potentially to use the standard data. Yes, precision. Yeah. So shelter. Completely. Yeah. Completely excluded. No, we have the ones that are on the reduced rates, but there aren't that many. So we've tried to play with reduced rate versus full rate. That was too noisy. No. So let's. Oh, sorry. Is there one question? Oh, yeah.
Whether you looked at the vehicles specifically, I'm doing eyeball econometrics here, so it's probably wrong.
We've done some eyeball econometrics ourselves on this. So we've we can look at the new car registration.
Yeah.
I think so. Sebastian Ziegler did that, I think, for Germany and Austria. And that, again, that looked quite similar in the two countries. But we felt like, the point here is to focus on the scanner data. Vehicles are not in there. And so perhaps there the effects are different. But what we've explored didn't look that there was a big thing there.
The one thing that looked somewhat suspicious is that from December to January, survival in the VAT extras is a big drop, and it doesn't seem like that's there, at least in pre-periods. But I haven't done that.
But you have, remember, there's a second lockdown in Germany at that point. So I don't know if but that's, that we should compare to the Netherlands that has the same timeline for lockdowns. I think it's an interesting idea. Great. So, in fact, going now to the model inspired by your work with Valerie. So to interpret the magnitudes of quantities, we want to think about the implied EIS. And so in this model from the QBJ paper of Johannes and Valerie, also used by Olga and her team in their paper, you can have like nice closed form solution for the quantity response, which depends on the EIS, some terms that capture the user cost and stock to flow adjustments, and also potential adjustment frictions. Of course, you could also want to see that in alternative models. For example, a model of durables with adjustment cost and various financial frictions, maybe modeled more explicitly than with broad adjustment frictions. For example, Beraha and Zorzi could be another starting point that we think we will work on in the future. You could also consider, say, behavioral models with rational inattention and see how much rational inattention you need to get small quantity responses. But I'm not going to show you that today. I'm going to follow the baseline model for today. So this is the model where you have a household getting utility from non-durable consumption, service utility from owning a durable stock. There's a Calvo type friction, so that can capture many kinds of frictions. That means that only a fraction 1 minus theta of people can adjust their stock of durable in each period, where here a period is going to be a month. So the household maximizes this utility function subject to a standard per period budget constraint where you have the interest rate, you have inflation, which is the term next to the interest rate, which here we say just comes from VAT. And then you have the EIS, depreciation of durable goods that show up in that fairly standard structure. So yes.
Think about storage of non-durable goods in this context. So there's something like, say, milk. I don't necessarily want to change how much milk I drink every day because of a change in taxes. But if I'm going to buy milk, I wait till July 1st to buy it rather than buying it on June 30th because it costs less on July 1st than June 30th. And so you'd expect that to show up in the estimates, but I'm not sure what the analog is here.
Here it's going to show up through this depreciation parameter delta. So you see here in the budget constraint, right? You have then X, which is the net purchase of durable goods. And so the durable good depreciates at rate delta. And
like milk, we think would be classified as a non-durable, I assume. But you still expect that people would move when they consume it in response to taxes, or not consume it, I'm sorry, when they purchase it in response to taxes.
Yeah, so falling. Yeah, so milk would be in C. And so people would also intertemporally adjust that. But it's just that the price incentive for milk is actually going to be weaker because people take as base the actual full price of milk, while for durables, what matters is the user cost, which is just a fraction of the total price, which is why then compared to the actual VAT change, that becomes a much stronger price incentive. That's, yeah. Yeah.
One paper did after where they look at a value adjustment, I believe in Japan, they showed that there was a lot of many storable goods that were kind of stocked up on that in toilet paper.
So, so just for me to understand the distinction. So here, the durable goods are things that are stored and depreciate, but here you're alluding to something different, it seems.
something like that.
Yeah.
Is that even D in data model?
That, yeah.
D.
I would put milk in C because you can't really store it, but then the baked beans, I would say, yeah, that it has, it will also depreciate, could go bad, but it's not going to be as fast. And so yeah, I would like classify it between these two categories. So let me show you just a few key equations. So to keep things simple for the discussion, we can try to see how optimal durable consumption responds around a temporary one period change in VAT. So I just cut VAT for 1 month and I bring it back. And then we could do this for instead 6 months and it would make formulas slightly more complicated. So for a temporary change in VAT, like just 1 month, then you end up with a formula like this, where you have a bunch of terms that might seem forbidding, but we can unpack them in the next few slides. For now, just note that this is a response that depends on sigma, the EIS, but also the pass-through kappa, the user cost, which is R, the monthly interest rate, plus delta, the depreciation rate, and also some friction theta. So if I can take 3 minutes, yeah. So we take standard values that come from the literature or from our estimates. So we look at the average lifetime of the durable goods in our sample. So we're going to match the estimates from the sample I call durable so far. And so from that sample, we look at the average lifetime, 6.38 years. We convert that into a depreciation rate. Estimated pass-through in the sample was 65%. And so then we're going to take as a quantity response what we saw in our data around June to July and December 2020 to January 2021 and see how that point estimate relates to what comes out of the model. And so first, we take an extreme benchmark, which is frictionless. So theta is going to be 0. Then we see that this response of purchases of durable goods to the VAT change, which in the data is minus 0.46, is a sum of all these terms. So you have the sigma, you have the pass-through, and then you have kind of a user cost term. And so the intuition for this is we kind of normalize the VAT change relative to the user cost, which is going to then govern the price incentive to adjust the stock of durable. Then there's an adjustment for going from you want to adjust your stock to how much you have to adjust your flow to get to the new stock. Then there's a pass-through rate itself. And so if you plug in the numbers, you find that the implied sigma here is extremely small. Now, you might say this is not a reasonable benchmark because you have no friction whatsoever. So here is perhaps a more reasonable benchmark where we bring the same level of friction as in Johannes and Valerie's paper. So only 15% of people are going to adjust their stock of durables. And so now you have new terms that show up and effectively it just dampens the response because only a fraction of people can adjust their behaviors. And when you do this, you end up with a sigma of 0.016 that corresponds to our point estimates. Then to account for the standard errors, we can do the same exercise, but taking the upper bound of our 95% confidence interval. And so you can see here for the kind of the baseline with the friction of 0.85, the point estimate I showed you earlier for sigma is 0.016, and the upper bound is 0.088. So it's the 0.1 number that I mentioned initially. So that's kind of the key table to remember in terms of these quantity effects and the implication for the elasticity of intertemporal substitution. So to wrap up, we looked at this VAT change in Germany. We found a sizable reduction in prices with an average pass-through of 76%, but no strong response of quantities. And in fact, through a simple model, this implies an upper bound on the EIS of about 0.1, which is consistent with low EIS estimates in some other contexts. And so very happy to discuss further any question you might have. Thanks a lot for all the suggestions. I don't know if we can take one question or if we're out of time. Yep.
I think we have time for a question or two if there are additional questions. Okay, if not, then we're going to reconvene at 3.
Right.
You know, only the French and the Spanish are actually.
Yeah. Yeah. Thank you.
Hi, thank you. Yeah. Yeah, yes, I do.
Thanks. Awesome. Thank you.
All right, let's get things started again, and Josh is going to present our next paper.
Thanks so much. I really appreciate Emmy and John putting this paper on the program. I also appreciate all of you being here. I know that there's a somewhat more exciting entertainment on offer starting right now. I will interpret all cheering as a sign that I've made an excellent point. So this paper is joint with my former colleague, John Leahy at the University of Michigan, who, as many of you know, tragically passed away last fall. He deserves a lot of credit for this paper. He was somebody incredibly fun to talk with about economics, and this paper owes a lot to conversations with him. And many parts of the paper benefited from his work. In particular, the model was very much his model. This paper is also joint with John Mondragon from the San Francisco Fed, who unfortunately can't be here, and Johannes Wieland, who is here and to whom I'll be happy to defer your hardest questions. John and Johannes, being at the San Francisco Fed, do note this disclaimer here that the views are ours and not necessarily those of the Fed. So the argument of this paper is in the title, that there are real effects of nominal interest rates. And this, of course, is in contrast with most economics, certainly what I have taught my students for many years. Usually we teach that it's the real interest rate that matters for the economy, for the macroeconomy in particular. We heard about this yesterday, for instance, in Gali's paper. Our paper is going to be much more aligned with what you would get if you talk to ordinary people out on the street, which is that the nominal interest rate matters. I should say this isn't just ordinary people. It's also the case that if you pick up something like the Wall Street Journal, you will see a lot of data and discussion of nominal interest rates. You will very rarely see any mention of the real interest rate. So we're going to argue that the structure of loan contracts, particularly mortgages, means that it is almost inevitable that nominal interest rates will have real effects in the economy, quite apart from any sort of money illusion. So money illusion may well be there. That's not the subject of our paper. Our paper is arguing that even if people are completely rational, given the structure of mortgages, there's going to be real effects of nominal interest rates. Our empirical evidence for that is going to be from the Michigan Survey of Consumers and also from mortgage level origination data across US cities. We'll have a model where our goal is to just have the simplest possible modification to the standard New Keynesian model where we can see some of the same qualitative things that we see in the data. So we'll be adding a payment to income constraint that depends on the nominal interest rate to the standard New Keynesian model. And the result, both in our empirics and from the model, is that an increase in the nominal interest rate will be contractionary, even if real interest rates are unchanged. This is not new to us. This idea that the structure of loan contracts means that nominal rates will have real effects was something that economists talked quite a bit about in the 1970s and 1980s, because that was a time when there was high inflation and high nominal interest rates. So there's many papers I could have cited there, but one of the early papers is this paper by Lessard and Modigliani. There was some later work by Wilcox, making similar arguments to ours about how loan contract structure means that nominal rates will matter. What's new in what we do is our empirical evidence and also our model. More recently, there's been some work on the long-run effects of steady state inflation on the housing market. And then there's lots of recent work, some of the authors are probably in this room, on mortgage market institutions. And a lot of that work has implicit in it that nominal interest rates are likely to matter given the importance of payment to income constraints. But that work, unlike ours, is not explicitly concerned with the effect of nominal versus real interest rates. In terms of theory, there's not a lot of close work. The closest are perhaps a pair of papers by Garriga, Kidlin, and Sustek on mortgages in macro models. Okay, so I'm going to start by saying a little bit about what exactly I mean about how debt contract structure means that nominal rates will matter. Then we'll talk about consumer survey evidence, evidence directly for the mortgage market, and then a bit about this model. So debt contracts. When we write down models, in general, our models have one period debt. You borrow money today, you repay it all with interest at some future date. So for instance, in a standard macro model, if you thought about a mortgage, you might think about you borrow, say, $1.5 million for a mortgage today, you repay the entire $1.5 million plus interest in 30 years. But that's, of course, not how actual mortgage contracts work. So real world debt contracts, and I keep saying mortgages here. I should say this is broader than mortgages. The same logic applies, for instance, to car loans. Mortgages are the most important example. So in general, I will say mortgages. But so mortgage contracts tend to have the following three features, as well as other debt contracts like car loans, that the debt is multi-period, meaning that it requires multiple payments during the life of the mortgage. You don't just pay it all back at the end. Second, that you repay the debt with a constant nominal payment each period. So for instance, if I were to buy a house right now in July 2026, I would make 360 identical nominal payments from July 2026 through June 2056. And third, lenders resist, indeed resist is perhaps too weak a word, they in general refuse to make loans in which the total amount of your monthly debt payments, meaning what you pay on your mortgage, but also other debt payments that you have like car loan payments, if that exceeds 45 to 50% of your income, you won't be able to get the mortgage from a bank. And the bank there is simply looking at your current income. They're not thinking about what is your income path over the next 30 years. They're thinking about what is your wage today relative to what is your first mortgage payment. And to be clear, that 45 or 50% today, that is an institutional feature of the US mortgage market. But even in a different regulatory environment where, say, banks could give larger mortgages if they wished, you would still have payment to income constraints being important because people can't spend more than 100% of their income on debt payments. And since people have to do things like eat, in general, they're going to face payment to income constraints that are significantly less than 100% and are likely not that much higher than 50%, even if banks were willing to give the loans. So just to make this clear, let me give an example. Let's suppose there's a household, they earn $100,000 a year, and they face a debt to income constraint of a half, meaning that mortgage payments have to be less than $50,000 a year. Let's think about what size mortgage that household can obtain. In the first case, let's suppose that expected inflation is 0, the real interest rate is 0, and the nominal rate is 0. In that case, if the nominal rate is 0, and you can pay $50,000 a year, all your payment every year for a mortgage goes to principal, so you can borrow $1.5 million. Now let's go to case 2. We're going to keep the real interest rate at 0, no change to the real rate. Our standard models would say there should be no effect on behavior. But in this case, let's suppose expected inflation is now 10%, and so the nominal rate is also 10%. Well, now clearly that household cannot get a $1.5 million loan because if the nominal rate's 10%, you got to pay at least $150,000 in the first year. You got to pay somewhat more because you're paying some principal as well. And if you go through the algebra, in fact, to keep the first year payment under $50,000, the household can only borrow $470,000. Now you might be thinking, but when there's higher expected inflation, you'd also expect wages to rise over time. That's of course true, and the present value of a mortgage is the same in each case if the real rate is the same. But the fact that your wages will rise over time, that doesn't affect how this payment to income constraint binds at the time of mortgage origination. So the punchline is here, the same real rate, the maximum mortgage amount that the household could get in this example falls from $1.5 million to $470,000. And that logic, we think, means that it is very hard to imagine a world in which the nominal rate does not have real effects, given that this is how debt contracts are in fact structured. So another way to see this is with a graph. You could think about this effect of higher nominal rates as tilting the real payment profile of a mortgage. This graph illustrates that. So here, everything is in real dollars. The black dashed line is to illustrate in this example the household's income of $100,000 a year. It's in real terms, meaning it moves exactly with inflation.
in the case where nominal rates are 0 and inflation is 0, the mortgage payment every year in real terms is $50,000. It's flat. The household could, I should say, this is payments on a $1.5 million mortgage. The household could afford that $1.5 million mortgage. If the nominal rate is 10%, then the initial first year payment on that $1.5 million mortgage is over $150,000. That's a lot higher than the household's income. Clearly, they can't afford that. Now that diminishes a lot over time. By year 30, they're paying very little in real terms, but that doesn't help you get the mortgage initially. I should say that this graph, I think, also illustrates one reason why inflation may be more unpopular than sometimes makes sense to macroeconomists, is that we don't measure higher nominal interest rates when we're measuring inflation. We used to, and we'll hear more about this from Gabe on Friday. But to a household, higher nominal interest rates make it much harder to afford things. And so since higher nominal interest rates tend to go along with inflation, that's one reason I think why households may dislike inflation a lot. Indeed, this paper in part came out of my complaining to Gabe that I didn't like the fact that I was paying a higher mortgage. We were getting a new mortgage and I was having to pay a higher rate, and I was not happy about this, but the real rate didn't seem super high. And Gabe sort of helped me see this logic and maybe understand why I might not like that higher mortgage rate, because it was affecting my ability to pay it initially. Okay, so let's move on to some empirical evidence. So our first evidence is from the Michigan Survey of Consumers, where what we're looking for here is to see, is it the nominal or the real interest rate that drives home buying sentiment in the Michigan Survey of Consumers? The Michigan Survey of Consumers asks households, generally speaking, do you think now is a good time or a bad time to buy a home? It also asks households about expected inflation over the next 5 to 10 years. And so that gives us a survey respondent level measure of the real interest rate. Because we know what the nominal mortgage rate is, we can subtract for each household what their expectations of inflation are. That gives us a household level measure of the real interest rate. The survey also asks about house price expectations, so we can see how expectations of the general price level compared to expectations of house prices in their effect on home buying sentiment. And what we think is a particularly nice test for our purposes is that the Michigan survey asks people why they say it's a good time to buy a house. And a common answer is people will say it's a good time to buy a house because interest rates are low. And then we can look at, well, are they saying that at times when nominal rates are low, or are they saying that at times when their real rate is low? To give away the punchline, they say it when the nominal rate is low. So the basic specification is we have a dummy variable on the left-hand side, equal to 1 if people say it's a good time to buy a house. And then on the right-hand side, we have the nominal interest rate. That has only a subscript t because it doesn't vary across survey respondents. And then we have the real interest rate. That is a subscript j and t because it varies across time and across respondents. Yes?
They could refinance, right? They could assume that even if the interest rate is 10% today, they know that they'll be able to refinance at 8%.
Yeah, that's a good question. So we don't have any questions like that where we could get at that from the survey. You're certainly right that, there was this line going around a few years ago. I think it's probably disappeared somewhat. If people would say, marry the house, date the rate was the thing that people would say. And the idea being that the interest rate you'd get initially would not be the interest rate that you would have in the long run. So you're certainly right. I think that it's plausible that people's house purchase decisions would be influenced not only by the current mortgage rate, but by their expectations of what would happen in the future. I don't know that we have any way that we can test that exactly here. Okay, so here are results. Focusing on the first column and the top row, this is the coefficient on the nominal mortgage interest rate, where the minus 0.11 means that if the nominal mortgage rate goes up by 1 percentage point, there's an 11 percentage point decrease in the probability of people saying that it's a good time to buy a house. By contrast, the coefficient on the real interest rate is very small, and it's actually positive, meaning that conditional on the nominal interest rate, higher real interest rates make people think it's a better time to buy a house. So these results are inconsistent with standard models. A standard model would say we should see nothing on the nominal rate, and we should see a negative on the real interest rate, and we see basically the opposite of that. In columns 2 and 3, we control for the unemployment rate and then house price expectations. Those don't change our results at all. Column 4 is this test I was mentioning before, where the survey asks people to say why they think it's a good time to buy a house, if they say it is a good time to buy a house. So there, the left-hand side variable equals 1 if people say it's a good time to buy a house because interest rates are low. And that coefficient of minus 0.07 on the nominal rate says that when nominal interest rates are higher, people are 7 percentage points, or if nominal rates are 1 percentage point higher, people are 7 percentage points less likely to say that low interest rates are a reason why it's a good time to buy a house. And the real interest rate goes the wrong direction there. So it's pretty clear that when people say, go out and buy a house because interest rates are low, what they mean is the nominal rate and not the real rate. In the final column, we no longer look at the nominal rate because we include survey month fixed effects, so we don't have any variation remaining in the nominal interest rate. We compare the effect of expected house price inflation and expected overall inflation, and we get the sign that you would expect on expected house price inflation, that when people think house prices are going to be higher in the future, they say it's a better time to buy a house. We get the opposite from expected sign on expected inflation, that higher expected inflation. Here you could think about this as being conditional on the nominal rate because of the survey month fixed effects. That's a negative, meaning that when people think there's going to be more inflation, they say it's a worse time to buy a house, which is the opposite from the predicted sign. And that's what implicitly is in these coefficients on the real rate in other. Yes, Chris.
Inflation surveys is that the individual responses can get while the averages are okay. Should I be thinking about this instead of when you ask these people as you're forming the real rate, they are, what do you think inflation is going to be going forward? You get a lot of people saying 10%.
Yeah, so I think this is a great question. I think there's a couple of answers to that. So one sort of a econometric answer to that is that one approach is you could say, well, this is kind of cool because you have all these observations at the individual level, but maybe we don't actually want that because people are saying wild things. And you could collapse this all and just run this as a monthly time series. And you get the same result of a very negative on the nominal rate. The real rate coefficient becomes significantly larger, consistent with there being some sense of measurement error here. But the qualitative conclusions are the same. So that would be one sort of econometric answer. I think deeper answer in some sense would be to say that if you really want to go down the road of saying that people's answers about what their expected inflation is meaningless or measurement error, that in some ways I feel like you are almost already saying that the real rate cannot be the most important thing, because how can the driver of behavior be something that we say that people don't actually understand or are giving meaningless answers to? Now, I don't know if I totally believe that. Survey is not the same as what's driving actions necessarily, and so what one could debate that. But yeah, Gabe.
Question or comment. I thought, so when you have the mortgage rate and the real mortgage rate together, it's like having the mortgage rate and having the individual's expected inflation.
Correct.
You can just
Yes.
play around with that. And I thought the result for expected inflation was people tend to think in terms of supply shocks. So if they think inflation's going to be high, they also think their real income growth is going to be low. And so it seems like it might be useful to put people's own income expectations into these regressions, which you have in the Michigan survey, as a way of trying to strip out the second part of that.
Yeah, that's a great comment. We've tried controlling for income, but that's different from controlling for income expectations. So that's a good idea. Yeah. Okay, so let me move on then and talk about data that we have in the actual mortgage market. And there's two reasons we want to do this. One is that there's always a natural objection to survey data, that survey data is not actual action. So we'd like some measure of what people are actually doing. Another is that the evidence I just showed you is completely consistent with money illusion. So even if you believe that what I've showed you shows that the nominal rate matters, it doesn't tell you that it's this story I told you about mortgage contracts. It could just be people are confused about nominal versus real interest rates. And this data that we have for the mortgage market will allow us to distinguish those things. So we're going to look at actual mortgage market outcomes, and we take advantage here of geographic variation. So the nominal mortgage rate does not vary within the US. Actually, I just saw a paper this morning that before the mid-1930s, the nominal mortgage rate did vary quite a bit in the US. So perhaps one could do some interesting historical work taking advantage of that. But since about 1940, the mortgage rate has not varied regionally within the US. But our hypothesis about how debt contracts interact with nominal rates suggests that the effects of the mortgage interest rate, of changes in the mortgage interest rate, are likely to vary geographically. A higher nominal interest rate will reduce the volume of mortgage originations as it tightens payment to income constraints. And that implies that more borrowers are likely to be affected in cities where loans are large relative to incomes. And I'll go through some intuition of that on the next slide. We don't have data on payment to income, what people call the DTI ratio, before 2018. But the DTI ratio is strongly correlated with the loan to income ratio, the ratio of the mortgage loan size to a borrower's income. And we have mortgage level loan to income data starting in 1995. I should say that we're very grateful to the San Francisco Fed for having that data. Just a second. So here, let me illustrate the intuition for how we're going to use this data to get at the effect of an increase in nominal rates going through DTI constraints. So here, think about two cities where here we're using data for Houston and Los Angeles, where you have a city like Houston where houses are relatively cheap. And that's reflected in the fact that loan sizes relative to incomes, loans here are mortgage loans, are relatively small as a ratio to income. And here what we're doing is we're showing a histogram where this is the distribution of mortgages, where the x-axis is the size of a mortgage relative to income. And we're showing it for 2 years, in 2021 and 2023, where we've chosen those years because there's a very large change in mortgage interest rates between 2021 and 2023. In 2021, mortgage interest rates are 3%. In 2023, they're 6.8%. What you can see in the histogram is that the distribution of mortgages shifts to the left between 2021 and 2023. Mortgages where loan to income ratios were high tend to disappear when mortgage rates go up. And one way you could think about why that's happening is these two vertical lines show the maximum size mortgage that you can get, assuming that you can't pay more than 45% of your income in mortgage payments, where the mortgage rate is 3% and the mortgage rate is 6.8%. And you see that shifts quite dramatically from you being able to get a mortgage with a loan size to income of about 9 to a loan size to income of less than 6 when rates go up from 3% to 6.8%. Now you might object, well, why are there no loans in that region? The answer is partly here that we're doing that calculation assuming that your only debt payment is for mortgages. Most people in practice also have other debt payments, and so they face a constraint that is to the left of those. Another thing I didn't mention is that when you're qualifying for a mortgage, they're also including property tax payments. So people can't literally borrow as much as those vertical lines suggest. Going to the right now, we can look at Los Angeles, where, again, there's a decrease in the number of mortgages, a shift to the left, but it's much more dramatic. Why is it much more dramatic? It's much more dramatic because in Los Angeles, houses are really expensive. So people were getting mortgages that were really large relative to income, and they were getting lots of mortgages that lie to the right of that vertical line at 6.8%, meaning that they were getting mortgages where even if the only monthly payment they were making was for mortgages with no car loan payment, no property tax payments, they would not have been able to qualify for a mortgage like that in 2023. And so you lose many more mortgages in Los Angeles than you do in Houston. So that's the intuition for what we're going to try to apply more broadly in a regression specification. I'll just say that the sort of aggregate number here I think is interesting, that mortgage volume in total falls 27% in Houston versus 50% in Los Angeles. And the reason we like this identification is partly because this is not a prediction you'd get from money illusion. Money illusion, there's no reason to think that borrowers in Los Angeles would be any more confused about nominal versus real interest rates than borrowers in Houston. This seems much more naturally explained by this story we've told about the structure of mortgage loan contracts. Okay, so a regression specification is really just implementing what I just showed you in those figures, but in this case across 704 US cities and from 1995 to 2023. So here what we're doing is we're regressing on the left-hand side. We have the growth of, I say loans here, this is just mortgages, the number of mortgages issued in a city J in quarter T. And on the right-hand side, we're controlling for the level of the change in the nominal mortgage rate. We're binning cities into terciles based on the average loan-to-income ratio in that city. So tercile 3 is cities like LA, where loans are really large relative to income. Tercile 1 is cities like Houston, where loans are small relative to income. And then what we're particularly interested in is this coefficient on the interaction of the change in the nominal rate and whether you're in a city where loans are small or large relative to income. And then, since we want to distinguish nominal rate effects from real rate effects, we control for the real rate in exactly the same way. And our hypothesis is that this theta 3 will be less than 0, meaning that where mortgages are large relative to income, in this LTI bin 3, an increase in the nominal interest rate will depress mortgage lending more. And as I say at the bottom here, this directly tests for this DTI constraint channel. There's no reason to think money illusion would make theta 3 negative. Data here, we have mortgages originated and loan-to-income data are from Home Mortgage Disclosure Act data. As I said, we get that from the San Francisco Fed. Here, sorry, that this looks inconsistent that I say the sample here is 1996 and I said it was 1995 before. That's because we have 4 quarters of lags, so that the regression starts in 1996, the data starts in 1995. This is mortgage level data. It does not literally include every mortgage in the US. If John Mondragon was here, he could tell you exact details about that, but it covers the vast majority of the mortgage market. The nominal rate here is just the 30-year fixed rate mortgage from Fred. Obviously, something important here related to what Chris was asking earlier is how do you want to measure the real rate where you have to take a stand on what's expected inflation? Since what we're interested in here is decisions made by consumers on whether to get a mortgage or not, we think that consumer expectation measures of expected inflation are the best. And our baseline here is going to be simply average 5 to 10 year expected inflation from the Michigan survey. You might wonder, what's this combination of 5 to 10 year expected inflation with a 30-year mortgage? In fact, 5 to 10 years is what we have from the survey, but it's also actually ideal because the expected duration of a mortgage is something like 8 years because people often refinance their mortgages, as was mentioned earlier, or they move. And so when people get a 30-year mortgage, on average, they're not actually spending 30 years making those payments. So results, I want you to focus specifically on these numbers lightly shaded in gray here. This is that interaction between a city being like Los Angeles, having loans high relative to income, interacted with the change in the mortgage rate, where our hypothesis was that that was going to be a negative number, meaning that higher mortgage interest rates would depress mortgage loan volume more in cities like that. And that's exactly what we see. So across columns here, we are adding controls. First, for house price growth, whenever we add controls, we interact with LTI bin, the Fed funds rate, so that's controlling for just whether interest rate cycles in general are having different effects across these cities. And in the final column, city and date fixed effects, which because of the structure of our specification combined with it being a balanced panel, the coefficients are completely identical with the city and date fixed effects. So you can see that more as a sort of sanity check rather than an additional robustness check. The magnitude here of roughly -4 in column 3 and 4 means that if the nominal mortgage interest rate goes up by a percentage point, mortgage volume falls by 4 percentage points more in a city like Los Angeles versus a city like Houston. So the lowest LTI bin cities here, like Houston, are the omitted category. So that we think is pretty large in macroeconomic terms. It means that an interest rate cycle like that from 2021 to 2023, where mortgage rates go up almost 4 percentage points, would mean that you'd have mortgage volume falling 16 percentage points more in a place like Los Angeles than in Houston. I don't know that I have time to go into it. I can if people are interested. One can play around with different measures of expected inflation. So we also look at median expected inflation from the Michigan survey, although we think it's probably not our preferred measure because we're interested in households here. You can also look at tips. The Cleveland Fed has a measure of expected inflation we use. In all of those cases, you get a similar qualitative story. Quantitative numbers change as you would expect, given that depending what expected inflation is, you're going to get different loadings on the nominal versus real rate. Okay, so let me then move on and talk a little bit about what we do in the model. So our goal here in the model is to illustrate how it could be the case that the nominal interest rate might directly impact the economy, consistent with the empirical evidence that we've seen. And we wanted to construct a model that was as simple as possible to the baseline New Keynesian model, like that in Galli's textbook. The modification that we make is in the spirit of this 1987 paper by Lucas and Stokey, where we have a cash good and a credit good. These are both non-durable goods, but the credit good is subject to a payment to income constraint like that in the real world, meaning that you buy it today on credit, you pay for it the next period, and you can't commit to making a payment the next period that's larger than a certain share of your income today, where the interest that you pay is nominal, and thus changes in the nominal rate change how that constraint binds. Well, we'll see the algebra of that in a second. The payment to income constraint is going to mean, in ways that are not surprising, that changes in the nominal rate have real effects. So some details. There's a representative household. That household gets utility from the consumption of these two non-durable goods, a cash good that's indexed by N and a credit good that's indexed by D. There's prices of these two goods, PN and PD, consumption of the two goods, CN and CD. Utility is I think, what one would expect. You get utility from consuming both goods. What's new here is this borrowing constraint, where to purchase the credit good, as I said, the consumer pays the price plus interest in the next period, and they face this constraint, that the gross interest rate, 1 plus the nominal rate, times the price of the credit good and how much you consume of the credit good, has to be less than or equal to theta times the amount of your nominal income, where theta is this parameter saying how the payment to income constraint binds. So theta equal to 0.5, for instance, would be a 50% payment to income constraint. Yes, David.
So we started by mortgages paid off over multiple periods. And that's not true here. And
Yes.
the constraint is a fraction tomorrow's nominal payment, a fraction of today's
Income.
nominal income.
Correct.
So is this a sort of shortcut to getting a more complicated idea of the multi-period payments?
Yeah, no, that's a great question. So there is certainly some awkwardness between what I told you earlier and the model. We have an appendix where we go through with a long-term mortgage contract what this looks like. Our goal here was, let's see how simple we can make things and have the nominal rate matter. Now, I would say that this structure of the nominal payment tomorrow relative to your nominal income today, I think that is actually realistic. If you go to a bank, they look at your nominal income today and they think, what are you going to be able to pay tomorrow or sort of the next month? So I think that feature sort of is realistic, but you're absolutely right that we are abstracting from what I was talking about being quite important, this long-term nature of contracts. And, you might convince us that maybe we should move that out of the appendix, but yeah. Okay, so one implication of this that I think is less obvious and it was interesting to us is for the forward guidance puzzle. So if you take the Euler equation from this model solved forward, you have the first term is exactly what you have in the standard model, the real interest rate. But then you also have this term with the nominal interest rate, where the importance of the nominal interest rate for demand depends on how much you spend on the credit good relative to the cash good. And perhaps not surprisingly, in this simple model, it's just the current nominal interest rate that matters, not future nominal rates. And so you have in this simple model something that certainly helps you resolve the forward guidance puzzle. The natural objection to that is, well, what about long-term debt, as David was asking about? If you go through that, you get in the Euler equation, instead of this second term depending on the current short-term rate, you get that in the Euler equation, what matters is the long-term mortgage rate, where the long-term mortgage rate, the rho T that I have here, is a function of short-term rates over the life of the mortgage, where the short-term rates are weighted by these omega S weights. And those omega S weights are declining over time. So if you go through the math of a profit maximizing lender, you will find that mortgage rates depend much more on what the short-term interest rate is today or expected in 1 year rather than what the short-term interest rate is in 29 years. So we could see that here, this is the weight on current and future short rates in a 30-year mortgage rate when the nominal 30-year mortgage rate is 6.5%, and those weights decline. And so this is, we think, is sort of one interesting, perhaps, angle to think about the forward guidance puzzle, that if nominal rates are really important, just the structure of mortgage contracts means that nominal interest rates in the near term are going to be more important than expected nominal rates 20 years in the future, 25 years in the future. Okay, I'm almost out of time, so let me, yes, please. I'm sorry, do you need what? No. No, there's nothing in this. I should have said this. It's a good question. There's nothing in this. So this goes back to that graph I showed earlier with the tilt, where I was assuming that real income stayed the same as inflation went up. There's nothing. If you had a world where wages don't keep up with inflation, that would be another reason why nominal rates could matter. But this mechanism of tilting the real payment profile, you can have complete wage flexibility, and that's not inconsistent in any way. Okay, so let me conclude. You just mentioned a couple policy implications. So both the data and the model that we built provide a rationale for why the Fed focuses on nominal rates. So I think in some ways there's an empirical puzzle of why the Fed focuses purely on the nominal interest rate. In most of its discussions, it only talks about the nominal interest rate. Perhaps one reason for that, at least, is that there's many situations in the real economy where what's relevant is actually the nominal interest rate. Our argument helps to explain how increases in nominal interest rates can be contractionary, even if they're not accompanied by increases in real rates. So sort of, I didn't have time to get to this. An interesting feature of our model is that, in fact, the Taylor principle is preserved, that in order for determinacy in our model, it still has to be the case that real rates go up when inflation rises. But in the short run in our model, you clearly have dynamics where you can have output fall even if real rates don't go up. Something close to my heart is there's been, I think, a bit of a mystery of why we see in the data large effects of monetary policy surprises, but then in cases where we see expected inflation going up and decreasing the real rate, we don't seem to see large expansionary effects on output. So this was Johannes's job market paper. And one possibility is that the effect of monetary policy shocks that's a nominal rate shock. It changes how payment to income constraints bind. Changes in expected inflation don't change how payment to income constraints bind. So it could help to explain why lower real interest rates from higher expected inflation aren't expansionary in the same way that lower real interest rates coming from lower nominal interest rates are. So let me stop there, and I think we still perhaps have a few minutes for questions. Yes? Yeah, so there were a couple of papers by McGee and Yao, Bank of Canada working papers, where they think a little bit about this. You would certainly expect that it would have potentially long-run permanent effects on the housing market. It's not clear that you'd have permanent effects on output from this mechanism, but certainly you're going to make it harder for people to afford. No, that's right. I mean, I think this is outside what we're doing. Somebody could have asked this. We are taking the structure of debt contracts as given. You certainly might imagine that, certainly if inflation and nominal rates went high enough, presumably we would see some changes in how debt contracts were structured, and that would be one way this might be undone.
If you look at that reallocation, I thought
Christy?
So we're having a debate over here about how would this carry over to a country like the UK, where it has much shorter mortgage contracts. It seems to me as long as they have the same debt to income kind of constraints, it will carry over. Is that true, or how do you think about this?
Yes, the effect is going to scale with the length of the mortgage contract. So this effect will be larger when contracts are longer. So that's one reason why you'd expect sort of larger effects in the mortgage market than in, say, the car loan market. You can think about that because sort of with a 30-year mortgage, the way you're keeping real payments over the life of the mortgage constant is then the 30th year you're paying very little, and so you're paying a lot so that sort of tilt is less important the shorter is the contract. So I think in other countries with shorter mortgage contracts you might expect less of an effect, but the qualitative direction should be there. Yes.
So in the data, you're using the single 30-year fixed rate.
That's right.
But in the microdata, don't mortgage rates vary by household?
There is some variation. I'm not sure, Johannes, do you know if we observe that?
We see some, and there's not much. We played about it, you can about you can aggregate like city level, citizens. It didn't look that different. It makes me much just less elegant. Wonder like why are there places you have? I think this is like a way to run the economics. But they don't have some. It's like
Yeah, so I think that is like deep, like FICO scores and default risk, and you have a specific mechanism which goes through the DTI in that story, but there's presumably other mechanisms through which interest rate variations correlate with default risk, like correlates with other constraints like cost value ratios.
Yes, I mean for that you would need a story for why that was correlated with being in a high LTI city versus low LTI city. So we could talk more. Maybe there are stories there we need to think about. But yeah, back there.
I'm not sure what you expect because to an extent you're making out the right advantage, so you might expect more.
Yeah, so in our empirics, we cannot directly speak to that, although the empirics strongly suggest that you're going to have a decline in demand for housing, and so that's going to be negative for output. In the model, it works out where output falls, but you're absolutely right that's dependent on details in the model. Johannes, I don't know if you want to say more about. Gabe? Yeah.
I think I misunderstood the last bullet on your conclusion slide, and it seems policy important.
Sorry, I don't think I meant to move through those slides. So.
If I understood the bullet, it said lowering the real rate by having higher expected inflation, I guess. So it says higher expected inflation is not expansionary. And then you cite Johannes's job market paper and your other paper. But your job market paper is about doing this at the zero lower bound. And if you do this at the zero lower bound, then you get the expected higher inflation, but you don't get the nominal interest rate increasing.
Right.
So it seems like it is still simulatory. There's no offset if you're at the ZLB because you get the higher expected inflation, but the nominal interest rate is at zero.
Right. No, the argument, and I obviously thank you for asking because I wasn't clear, is that you might have thought take the evidence about the effect of monetary policy shocks. Looks like when the Fed cuts rates, you get things quite expansionary. You might have thought that tells us what happens when real rates change. And you might have thought that means that if you get higher expected inflation at the zero lower bound, that's a cut in real rates. We should expect to see the same effect on the economy as we see when the Fed cuts rates. And if what's actually driving economic activity after the Fed cuts rates is the nominal part, then it's less surprising why when we just see real rates fall without nominal rates changing, we don't see the same expansionary effect. That was the argument.
That channel is very weak, whereas the nominal baby in terms of the DCI would say it's not really tempo about it.
John?
I think you totally get rid of this effect, I guess, if you have indexed mortgages where the real payments are equalized over the mortgage. And we had that in Iceland for the longest time, and it turns out that people hate that. Because they say I've been paying this mortgage for 10 years and I owe more than I owed when I started off. So, even though you were not emphasizing money illusion, I think there's also money illusion.
Yeah, yes. No, thank you. And I think you know, if you wanted to try to explain why we have mortgages the way they are, I think that would probably be where one would start, that people in fact like this to some extent.
All right, let's thank Josh. And we're going to move straight to the last paper of the day, and Pascal is presenting.
Great. Thanks for sticking around, and thanks for putting this paper on the program. So this is joint work with Thomas and Andres. They're both here today. We're calling this paper Reaching for Duration. And the usual disclaimer applies. It's a bit more binding than usual because we're going to take a bit of a critical stance on quantitative easing in this paper, as you'll see. Okay, so here's our motivation. So bank maturity mismatch creates an inherent financial instability. This probably became most clearly visible in the case of Silicon Valley Bank in March 2023. So Silicon Valley Bank increased strongly its long-term security holdings when interest rates were low in 2020, 2021. But then when interest rates rose in 2022, the value of those long-term securities strongly dropped, which led uninsured depositors to withdraw their funds. Now, motivated by this evidence, by this experience, we're going to provide you, we went back to historical core report data to collect empirical evidence on the maturity structure for US banks. And we're going to provide you a new stylized fact in this paper, how that looks over the recent decades. Specifically, we went to core report vintages going back all the way to the 1950s, and we collected information on the remaining maturity or next repricing date of various assets and liabilities for US banks. Based on that, we computed dollar-weighted maturities of assets and liabilities bank by bank. What I'm going to show you are going to be averages across banks in the following pictures. One variable of interest is going to be the maturity gap, which is simply the difference between the maturity of assets and liabilities. So let me show you how this looks. So here what you see is the evolution of the maturity of assets and liabilities for the US banking sector. And as you can see, the average maturity of bank assets was around 2 years in the late 1950s, early 1960s. Then we have a bit of a gap where we don't have information. But after that, you see a steady increase in the maturity of assets, and then a stronger increases over the last 2 decades. On the liability side, we have information on the remaining maturity of term deposits. And for saving and demand deposits, we're going to assume a 0 maturity because ultimately we're going to be interested in the redeemable nature of these deposits. And as you can see, the liability maturity was pretty low and steady at around 0.4 years on average throughout this sample. Now, taking these 2 series together to construct the maturity gap, we see the following. This measure has strongly risen over the last decades from a trough of around 1.6 years in 1986 up to a peak of around 5.7 years in 2022. So this series more than tripled over the sample. One thing I want to highlight, and as you can see in this graph, I added these shaded regions, is that during the Great Recession QE period and during the pandemic QE period, this series sharply increased. That's somewhat in contrast to what I call like a first order view of QE, because what is QE just from a transaction point of view? It's the exchange of long-term securities against 0 maturity reserves. So what we should see from just if we're thinking about this first order view is actually a decline in banks' maturity mismatch. And what we see is the exact opposite during this period, which is quite striking, we believe. There was a question right there. No, so we don't have information on swaps or derivatives, but there is other work showing that that is very minimal for US banks. So we don't think that this actually has a big impact here.
especially the pandemic, the liquidity gap or financing gap falls a lot there.
Okay. Okay, we haven't looked at other
And then
data.
recent paper, from the Bank of Italy to show that we have granular data on the interest rate hedging of Italian banks. I show that at best they are hedging a third of their interest rate.
Yeah, so I have some other work actually, which kind of argues that due to regulation, and there are particular reasons why they would do that. If you follow kind of the line of work from Drexler, Savov, and Schnabel, banks take these long duration position in order to hedge their deposit franchise. So it's actually optimal to do it and not use derivatives or swaps to undo that. Yeah, so this is really the stylized fact we wanted to bring to your attention. Now, let me show you also another graph, and this is really evidence that this audience is well aware of, but I wanted to bring it again to the forefront here, which is that over this period, we also saw a strong decline in general interest rates. Here we're showing the federal funds rate, but also importantly for our story, term premia have also strongly declined over this period. And here we're showing you term premium estimates from Adrian, Crump, and Munch, but you can get a similar picture if you use other estimates. Now, these facts lead us to pose the following research questions. So first of all, why do we not observe this decline in banks' maturity mismatch during periods of quantitative easing, which is intended to remove duration risk from the private portfolios? And as said, if you take this first order view of QE, you should see that for banks. Secondly, why do banks increase, in fact, their duration of assets when interest rates and term premium are low? That's somewhat puzzling because the term premium is a compensation for taking duration risk. So why would you increase your portfolio when that compensation is low? And third, do banks optimally engage in such behavior, knowing that it may increase the interest rate exposure to a rise in rates thereafter, which can lead to deposit outflows and bank runs? Recall the experience of Silicon Valley Bank. Another question, yeah.
Did the Treasury increase duration over this period? Or is a market composition of it? Other parties that are reducing their duration holding, banks have cut up. What else do you know?
Okay, so first of all, I haven't shown you the decomposition for loans and securities, but we also see this maturity increase in loans, not only securities. Beyond that, I think there is a general picture if you plot the weighted average maturity of outstanding treasuries, that it falls first during QE periods, and then there is some evidence that the treasury actually worked against that by issuing some longer duration treasuries, so it starts to increase later. We didn't do a full analysis of all the holdings in the economy of all the actors, if that's what you're looking for. Yeah.
Some duration must be down private sector. It just turned out it's not coming up the banks. From other financial institutions like that.
So what we're going to do in this paper, we're going to try to answer these questions. And we start with a model of bank portfolio choice. So the model has the following key ingredients. So I'm going to try to provide you the key intuition for our mechanism. So the bank has the choice to invest in a short-term bond, which simply pays the policy rate, or a long-term bond, which pays the policy rate plus a term premium. The bank's also is going to have deposit market power, but it's going to face operating costs, which are substantial in the data. It has to cover every period. A key ingredient that we're going to include into this model is that banks are going to have concerns for their profitability. So the way we're going to model this is that the net income of the bank has to clear a certain level every period. I'm going to provide you with more motivation for that later on, but let's take that as given for now. Now, given this environment, we're going to derive a so-called reaching for duration effect. So when interest rates or term premium are low, the bank's net interest margin is going to get squeezed. Why is that? Well, when the short-term interest rate is low, the deposit spread is being diminished. And when the term premium is low, basically the excess premium that the bank is going to make between the policy rate and the long-term investment is also going to be low. So if banks have to satisfy this profitability constraint that I mentioned, they're going to have to increase the maturity actually on their assets in order to satisfy this constraint, to make additional interest income. Now, this leads us to a so-called QE paradox, where if you take the view that QE compresses term premium, it's going to lead banks to reach for duration, therefore it's going to concentrate, in fact, duration risk in the banking sector. There was a question. Yeah, yeah. There are some, yeah. I think it depends a bit on models, how negative it was, yeah. But
why is it that these profitability concerns are so much stronger for banks than for other parties that might hold duration, like hedge funds or?
yeah, I think I will come back to that when giving you more motivation on this constraint. Yeah.
Credit risk and offshore from refinancing on mortgage. When mortgage rates are low, people are not going to refinance, so it's less risky for you to hold a long duration mortgage on your balance sheet. One way you get more credit risk, like compensation. And how does it work?
Okay, so we have an extension of the model where we introduce loans. I can talk about that. It basically gives the bank some additional spread income, which is partly going to alleviate the constraint. But on the mortgage side, I think we're taking more of the view of the investment decision of the bank, less so of the refinancing decision of a household or so. But maybe we can talk more about that later if I misunderstood you there. Now, this is going to have some financial stability implications. So we're going to introduce bank runs into this framework. And what's going to happen is that if there is a rise in interest rates subsequently, a run equilibrium can arise. And if you've taken a larger mismatch ex ante, that's going to imply a greater exposure to this run equilibrium. Now, coming back to QE then, again, if QE compresses the term premium, banks are reaching for duration. This may lead then to a greater run risk to that rate reversal later on. We then also going to extend our simple baseline framework to a dynamic continuous time model, going to derive some additional results for that, specifically that banks are actually reaching for duration even if they're not at the constraint yet, but they anticipate to be there at one point. We're also going to use this model to do some quantitative evaluation of this decline in rates and term premia. We're going to provide some additional bank level evidence, which is in support of our mechanism. And today, I'm not going to have much time to talk about this. We have some extensions in the paper where we introduce loans, as well as endogenize the term premium, which gives some additional amplification effects. Okay, so let me start with the baseline model. So our model has 3 dates. So t equals 0, 1, 2. And there's going to be 2 periods between those dates. There's a continuum of identical banks, and we're going to analyze the problem of a representative bank. The bank's balance sheet looks as follows. So the bank is endowed with equity and deposits, which you're going to take as exogenous. And it can invest in 2 assets, either a long bond or a short bond. The bank chooses the long bond share, so alpha, at time t equals 0, and that's really the only decision the bank makes in this framework. The short bond pays the policy rate RS0 in the first period. It's going to be rolled over at t equals 1, and then pays RS1 in the second period. The long-term bond pays the return RL, which is the average expected short-term rate over the 2 periods, plus a term premium. We're going to take the term premium here as exogenous, and that's going to be the key parameter that we're going to vary in our analysis. As said, we have an extension where we endogenize that, but that's not for today. At t equals 1, there's going to be an interest rate shock, which shifts the short rate from RS0 to RS1, where the shock is denoted by epsilon, and that has a mean 0 and a variance of sigma squared. Banks also face operating costs per period, C, and note that operating costs for banks are substantial in the data. So non-interest expenses relative to assets for banks are not 2.5%. So in practice, banks have to cover costs for branches, personnel, technology, etc. That's where these costs are coming from. Further, we're going to assume, and this is by now somewhat standard in this literature, is that banks have deposit market power. So the deposit rate is going to be a fraction of the policy rate, where beta here is between 0 and 1, and that's the typical deposit beta in the literature. So the banks are going to make a spread on between deposit rates and investing short. We're also going to define a variable which we call lambda, which is the non-repricing funding of the bank, which is simply the total balance sheet, which is here normalized to 1, minus the deposits times beta. So that's all the funding of the bank that doesn't reprice with interest rates. Then we can define net income at t equals 1, which is going to be the difference between the bank's asset income from investing in the short and the long asset. It has to cover the deposit costs as well as some operating costs every period. This can then be written as the non-repricing funding, where the bank is always going to earn the policy rate on that, plus it's going to earn the term premium on the share where it invested in the long bond, minus the operating costs that it has to cover. The net income in t equals 2 is defined equivalently. I'm here going to skip this, but just with the difference that there is going to be the interest rate shock, which is going to lead to a slightly different expression. Now, the object of interest for us is going to be the terminal payout for the bank, which is the cumulative net income net of initial equity. And here that's approximately 2 times the net income in period 1, plus 2 terms related to the exposure to interest rate shocks. So the first term is going to be the exposure coming from the short bond. So the higher interest rates in the second period, the more the bank is going to benefit from this interest rate increase, right? Because it's going to invest, it's going to be able to invest at this higher rate. But it also faces some cost, given that it has repricing liabilities. So the more of the bigger the share of its repricing liabilities, the higher those costs. So that's why it's going to have a negative exposure to the interest rate shock. Now we can then define a so-called hedging portfolio, which is the portfolio such that the variance of this terminal payout is 0, so that the terminal payout is essentially deterministic and independent of the interest rate shock. And that is the case if the bank invests a share 1 minus alpha to be exactly equal to the share of its repricing liabilities. Intuitively, the benefits and the costs are exactly going to net out in terms of the cash flows. Now, this may sound familiar to people who know the paper by Drexler, Self, and Schnabel, 2021, where they argued that the banks should have an asset duration which matches their liability duration. Here we generalize that by also taking into account equity. Finally, and this is the last ingredient, we're going to introduce a profitability constraint here. So the way we're going to model that is in a sort of reduced form way, that the bank's net income has to clear a certain level every period. Since equity is exogenous, this is essentially equivalent to a return on equity floor. Now, there are many reasons why low earnings are costly for banks. One is that bank capital is mainly acquired through retained earnings. So if you have persistently low earnings, you're going to face either costly equity issuances or regulatory actions. Supervisory ratings, analyst ratings often depend on bank earnings. Take, for example, the CAMELS rating, where E in CAMELS stands for earnings. Wholesale funding of banks often depends on their persistent and positive earnings. So we take all of these reasons together here in modeling it in this way. Now, reminiscent of that is that banks in the data, they strongly try to stabilize their dividends. Their return on assets is very stable at around 1%. And there's evidence that banks target return on equity directly. Now we're going to derive the optimal portfolio. So here we're going to assume that shareholders are risk averse and they maximize mean variance preferences over their terminal payouts. Now, taking the expressions from the last slide, we can rewrite this maximization problem and take first order conditions, which then shows us that the long bond share is going to be the optimal investment in that. It's going to be composed of two parts. One is the hedging part. So if the bank was infinitely risk averse and it wants to completely take away the variance of its terminal payouts, this is how much it would invest into the long bond. But if the bank is finitely risk averse and the term premium is positive, it may want to go beyond that. And this is what we call the myopic component related to Merton. So the higher the term premium, the more the bank wants to make use of that return and invest more in the long bond. Now note that this is contrary to the evidence that I've shown you at the very beginning, which is that at low term premium and at low rates, we have banks increasing the duration of their assets. This unconstrained problem would predict actually the opposite, that if term premium are increasing, banks are increasing the share of their long bond. Moreover, this share is independent of the short rate. So this again couldn't explain the empirical evidence that I showed at the beginning. So, but how does this solution look if we take into account this constraint and let's assume this is binding? So then the optimal portfolio is given by this expression here on the slide. And note now that this has the opposite predictions. So if the term premium is low, banks are increasing the share of their long bond. And if rates are low, they do the same. And why is that? Because their net interest margin is being squeezed. So they need to invest more into the long duration asset in order to boost their net interest margin. And so this is consistent with the evidence that I've shown you at the very beginning. So and then the optimal portfolio is going to be, of course, the maximum of the two. So let me show you how this looks graphically, I think, which nicely gets across the intuition here. So here I'm showing you the optimal portfolio in a tau alpha space. So tau is going to be, which is the term premium on the x-axis, and the long bond share is on the y-axis. So now there are two lines. One is this upward sloping line, which has an intercept of lambda on the left here, which is, again, recall, this is the hedging portfolio. And the higher the term premium, the more you would want to invest in the long asset. And then there is the constraint solution, which is downward sloping convex, and which predicts that the lower the term premium, the more you actually have to invest in this long asset. There's going to be a point where the two cross, and this is the critical term premium threshold. If the term premium is below that, the bank would have to actually increase its portfolio share in the long bond. So again, let's go back to QE. So if the term premium declines, QE increases the asset duration of banks in this constrained region, and this effect is convex. The additional increase the banks have to make increases the lower the term premium. Now, this constraint region also widens at low policy rates, which is exactly when QE is employed, which is consistent with the evidence that I've shown you at the beginning. Okay, if there aren't questions, I'm going to move on and now introduce,
Question, which is the model or the unprofitability region, if tau is less than, term premium is less than, as I understand it, roughly 2.5 percentage points.
Yeah, okay, so
But anything obviously breaks down
is
negative.
right.
But it seems like your model, it feels like something's missing.
Right. So let me answer this in two ways. So first of all, this unprofitability region here simply depends on that we normalize the share to be between 0 and 1, and we could extend that to go beyond 1. Simply if the bank is allowed to take more leverage, and it's going to hit some kind of leverage constraint. So that lower bound just depends on that there is some lower bound. But on the term premium being negative, I think in reality or in practice they of course issue loans, which allows them to make an additional spread. And we saw, I didn't show this here, but we find in the data that they also increase their loan maturities. So even if the term premium is negative, they may want to go still beyond that. So, okay, on that, so in the model, we don't, the expected interest rate path is completely flat. Okay, so we attribute everything to the term premium. So what you really need is only an upward sloping yield curve. Right. So as long as you get a higher yield on the longer term stuff than the short term stuff, you always have the incentive to go into the longer term stuff in order to get to profitability. That's essentially what we need. But in the model, we don't have any expected rate path, so that's why we attribute everything to the term premium. So this might be, the terminology might not be great, so we should clean that up. Great. So now I'm going to introduce bank runs into this framework. And the way we're going to do this is basing on some recent work, which modeled these deposit franchise runs. So let me explain how this works. So we're going to make two additional assumptions. One is that there's going to be a fraction U of depositors, which is uninsured. And secondly, we're going to assume that this interest rate shock is going to follow a uniform distribution. This is just because it's going to give us some convenient expressions in closed forms. Now, the way we're going to model these deposit franchise runs follows recent work by Drexler, Schnabel, and Wang, as well as Jiang and others, which came out after the SVB experience. And here the idea is that when uninsured depositors leave a bank, they also take with them the deposit franchise value that they have to the bank. And this can render a bank insolvent. So here I'm showing you this equation for the deposit franchise value. It's essentially that they're taking with them essentially this deposit spread that the bank is making. This has value to the bank. And this can render, therefore, the bank's overall value to be negative. Now, runs are possible if the interest rate shock is sufficiently large and if the term premium is sufficiently low, which is a region when the bank has a bigger maturity mismatch, so it's going to be more exposed to the interest rate risk. So I think this can best be captured again in this graph, which takes essentially the same calibration that I had before, but just introduces these additional run. And what happens is that there's an additional region that opens up, which is this run risk region, which opens up below a term premium of the term premium below this critical threshold. And this is equivalent to banks taking a very long duration position. So if they have this long duration position, they're going to be more exposed to this run risk. So if banks are at the constraint, they expose themselves to these run in this constraint region if we are below a term premium of this critical threshold. Now, again, coming back to QE, it's can lead banks to reach again for this duration. So we're going to have a greater exposure to this rate reversal following in the second period. All right. We extend our baseline setup to a dynamic continuous time model in the framework. There are three reasons why we do this. One is that it's going to give us persistent effects of interest rates to short rate shocks. It's going to allow us to analyze a problem where the bank dynamically trades over time. And we're going to be able to analyze the so-called ex ante reaching for duration effect, which is that the bank may reach for duration even before it exactly hits a constraint. So let me explain how this setup looks relatively briefly. So we have now time being continuous. The balance sheet is defined in levels, where the bank again invests in a long bond and a short asset. It is endowed with some net worth and some deposits. And the asset returns for the short rate follows this autoregressive process where we have some shocks to the short rate. The long-term bond return is composed of the return to the short rate, plus, again, an exogenous term premium. And now the long-term bond return loads negatively on these short rate shocks, right? So the value of long-term assets declines when there are positive shocks to the short rate. Bank's net worth evolves as described on the slide, where again, the bank is making some asset income from investing short and long. It has to pay its deposits, the general interest rate. Plus now we assume that the costs are scaling with the amount of deposits, which we assume here evolve exogenously. The objective of the bank is similar as in the two-period model, that the bank maximizes final period payoffs and the bank is risk averse. The way we introduce this profitability constraint is that the bank has to clear, again, a return on equity floor, which has to hold an expectation. Now, from this framework, we get, again, a solution that looks very similar to the one of the two-period model, whereby the optimal portfolio is the max of either the constraint or the unconstrained, where the unconstrained solution looks very similar as before. We have this myopic component, and now we have a hedging component that also depends on the possibility of a future binding constraint. The constrained portfolio share is going to take a similar expression as before. So now the key difference to the two-period model is that there is this risk of a future binding constraint. So when future cases where that constraint binds are cases where the bank's net worth is low and highly volatile. So in order to hedge against those states, the bank may want to increase its asset duration ex ante and generate additional net worth. And we call this the ex ante reaching for duration. So let me show you again how this looks graphically. So as before on this graph, you find the unconstrained and the constrained solution. So the unconstrained looks similar as before. It's simply this upward sloping line. And the constrained solution is, again, this downward sloping and convex curve. So recall that in this 2-period model, the solution was simply the outer envelope of these two, but now the solution looks actually slightly different. It's given by this orange line. So the intuition on that is, and I think it's best captured by starting from a high term premium where the two coincide. If the term premium is now, think of the term premium now declining, there is the risk that the bank may face this binding constraint in the future. In order to hedge against that, it actually starts to increase its asset duration even before it hits the constraint. And even in the constraint region, it might be above that because it's worried about a state where it's really going to be constrained in the future. We now also use the model for quantitative evaluation, and that looks as follows. So the idea here is that we feed into the model interest rates that are either low or high, as well as term period that are either low or high. And we're going to match those to the data. So we start from an episode where interest rates and term premium are high, and we take from these numbers from the data in 1985. And we're going to feed those into the model and see, first of all, if the model matches the data in terms of the prediction of the maturity gap. And we can see that the model is pretty close in terms of what it predicts the maturity gap to be. Now, if we now from that point decrease interest rates and term premium, and we decrease them to levels that we saw in 2025, we see a rise in the maturity gap. And again, it's almost exactly matching the data. And we can decompose where this is coming from. If it's either coming from interest rates or term premium, we find it's around half each contributing to this secular rise. So this tells us that the model does a really good job in predicting the maturity gap as various levels of the interest rate term premium space. Importantly, one thing that I also want to mention is that, in fact, in this region where interest rates are low and term premium are low, the constraint actually never binds. So it's purely driven by these anticipation effects that you could buy in the future. All right. In the few remaining minutes that I have, I want to show you some additional cross-sectional evidence that supports the mechanism that we have in our framework. So note that the aggregate trends that I shown you at the very beginning, they could also be driven by other secular changes like securitization, regulation, and so on. So what we're going to do is to differentiate our mechanism from these explanations is to use cross-sectional data using bank-level core report data that's directly going to test the predictions from the model. Specifically, we're going to run the regression where we have on the left-hand side here the maturity gap of the bank. We're going to take on the right-hand side the lagged level of that. So we're essentially going to be interested in changes of that. And we're going to regress that on a profitability measure. So here we're going to take a return on assets, so net income over assets. And we do that because net income is essentially a sufficient statistic for the various forces in the model. So low term premia, low level of interest rates, and high operating costs, they all reduce net income. So it's going to give us a direct measure to test our theory, because our theory would predict that less profitable banks would increase their maturity gap. Now, it's somewhat challenging to find plausible instrument here for bank profitability. So what we're going to do is we're going to saturate this regression with a number of controls and fixed effect and see if we find a stable relationship here across these various specifications. Now, recall that our model prediction is that we should find a beta that's negative, so less profitable banks are increasing their maturity gap. But there could also be a reverse causality story whereby if you have a higher maturity gap, you make additional interest income, which should increase your return on assets. But then we should actually find a positive coefficient if that's the case. We also use alternative profitability measures, and they give us very similar results as you see. So here's our key finding. So what we find is that we find a negative coefficient of around minus 0.5 in our baseline specification here. And that's very robust to including controls and a number of fixed effects here. Now, this tells us that less profitable banks, they extend their maturity gap. And in terms of magnitude, we find that's around 5 to 6 months per 1% return on asset, which is around a 1 standard deviation in our sample. We have some additional results in the paper showing that this maturity extension is really concentrated on the asset side of banks, arising mainly from securities, and that banks generate additional interest income by doing that. They raise their net interest margin. We also find that this effect is amplified in periods of low term premium, which we can measure either directly using some term premium estimates or the Fed holdings of securities scaled by GDP. Okay, so that's all I got. To conclude, what we started out with in this paper was that a new style aspect, we think, which is that banks' maturity maturities has more than tripled since the mid-1980s, tracking the secular decline in interest rates and term premium. We develop a model where banks face profitability concerns, and when term premium interest rates are low, they reach for duration in order to make additional interest income. And this increases their vulnerability to runs following interest rate reversals, which leads us to this QE paradox, which is that even though QE might remove duration risk from private portfolios overall, it can concentrate duration risk within bank, which can raise financial instability. We think this gives somewhat a new view on the 2023 banking crisis, specifically on the optimal decisions of banks before the crisis when interest rates were low in 2020, 2021. Banks may have taken optimal decisions at the time given the environment they were facing. And for future work, we think it's important to weigh these unwanted effects of QE against the intended macro effects that it may have. Right, that's all I got. Thank you.
We have some time for questions.
And then leverage determines how exposed my equity to the changes, but also determines how my profitability net income and tax the extreme effect. So you can both net income or that.
Yeah, so I think Andres also has some work where banks are essentially changing leverage. So they're kind of isomorphic at the end of the day. I think in the aggregate, if you look at bank leverage in the aggregate, it's pretty stable because banks are always pretty close to their maximum allowed leverage from bank capital regulation. Now there can be a bit of difference in the cross section, but at least in the aggregate, we see that it's pretty stable. So it's mainly coming from the duration then changes in the aggregate, and that's the story we're after.
Marginal in long-term bond markets, so the long asset is from the highest trends. Our story seems to be the exact opposite. One of those things can like.
Yeah, so the way we read this evidence is that banks are partly pricing the term premium to some extent. The way we try to capture that is in this endogenous term premium extension, where we're essentially saying that the term premium is going to be a function of banks' demand. So the more they demand, the lower is going to be the term premium. We think this is an interesting extension because it essentially is going to give us some additional feedback. So if you are in the constrained region and the banks have to reach for duration, they increase their long-term bond portfolio. That's going to deplete the term premium, and that's going to lead to an additional effect that they have to reach even more from duration. So you can see this here, kind of maybe as a stylized extreme example, but this curve is even steeper. Yeah.
Their story is that these banks are marginal markets. They're absorbing more flow, and that's forecasting higher returns as opposed to I think these stories are opposed. I'm just curious why.
Okay, maybe what you're alluding to, one thing we were thinking about was actually to run the Haddad-Sread regressions exactly in our continuous time model, which would be kind of interesting. Maybe that gets a little bit at that. But the way we understood just the general evidence is that banks are partly pricing the term premium. And this is kind of what we try to capture here in this reduced form way. But maybe we can talk afterwards a little bit to reconcile it. Okay. Yeah, could be. Yeah. Yeah.
information from the banks take them out.
Yes,
To show us that, okay, maybe the banks got such a way to lend. That means somebody else has to reduce the duration.
exactly. Yeah.
So, like in 2008, when it's like, okay, we really want to get information out of the money market funds, so that like proof of financial stability, the banks are actually helping us. And then in 2022, 2023, like the other way, right? So, exactly how this fits in with financial stability, I think is a bit more subtle. It's not just about, right?
Yeah, 100%. I mean, we didn't mean to cover the entire financial sector here. This is sort of very concentrated on focusing on banks here, our analysis. And with respect to, we have that prediction. Mhm.
What's special about the bank? Right? That ability model.
Right. Yeah. So I tried to give a number of reasons why banks really care about earnings, and which gives rise to this profitability constraint that we put in the model. So that would be, I think, the reasons. Yeah.
I mean, if you just look at the market, you see falling interest rate falling. There's less compensation for holding long-term asset, and yet banks load up on it. Okay, how do you get there, right? So the standard, unless there's some strong change risk that's the whole with the hedging demand, that's very hard to explain with this technology. You need something else, right? And so the profitability constraints will prevent that. Now, I mean, is that the only thing that drives it perfect? Is that probably not? So there are other factors as well. But I mean, just from how banks use that kind of market, I think that's
Yeah.
Comment, question, or related to this discussion. Comment is, one effect of QE is that it lowers long rates and increases mortgage demand, which stimulates the economy. The Gage-Shuttle Wright had a Brookings paper about 10 years ago on the effects of QE on financial stability, and his point, the message I took from that paper is helping the macroeconomy is really good news for financial stability. And so if you're thinking about, well, yes, there is this channel through which it worsens, there's also a channel through which it helps. So it's important not to help.
Yeah.
The question is, so there's this puzzling fact, and you kind of go, here's a story that explains it. And it's very hard for those of us who don't think about banks, but yeah, that sounds plausible. You have a little bit of evidence for it. It's probably not the only possibility. So are there other hypotheses out there about why we see duration going up in these QE periods? And I'm the sort of person who want to go, read the Wall Street Journal or the American Banker, who probably didn't notice this and they say it's all reaching for duration because of profitability constraints, or are there other stories floating around?
Yeah. Yeah, great points. So on the first, I think specifically the mechanism you probably have in mind is the capital gains effect. And there have been some papers showing that by doing QE, you increase security prices, so that alleviates some constraints of banks and they lend more. Sort of, that's kind of, I would say that's kind of I would put that in like a macro effect because you have more credit supply. Now, the second is that I think I mentioned this here a bit, that there could be other stories explaining some of these aggregate patterns, like, for example, trends in securitization, regulation, maybe even demand for more long duration assets. This part of the paper is meant to distinguish our mechanism from these aggregate trends, which is to go to the cross section and see if we find evidence for this mechanism, and we do. And that's, I believe, our answer to that part of the question. Yeah.
Okay, so let's call it a day. And I just want to remind you that tomorrow morning we're meeting, in the morning as opposed to the afternoon, and that's a joint session with macro, money, and financial frictions, and that's going to be over on the west side in the ballroom. So see you all there.
That's related to our